Okay, I think we have good numbers. I'm sure we'll have a few more joining us, but I think it's a good opportunity to get started. So welcome to today's training session this morning, everyone. We really appreciate you being here to join us. This training is really a very collaborative effort driven by that real demand that we're seeing for more information about the ISSB standards. So we'd firstly like to offer our sincere thanks to Bursa Malaysia for co-hosting this session with us today and bringing us all together. We'd also like to thank our partners in delivering this training, the IFRS Foundation, IFC and Bloomberg Philanthropies. And of course, we'd like to offer our big thanks to you all for dedicating this time to join us at the training session. So with that, I'd like to firstly introduce Dr. Hezri Adnan, who is Director of Group Sustainability at Bursa Malaysia, and will be giving us some opening remarks. So thanks so much for joining us, Dr. Hezri, and over to you.
Thank you, Fiona. Greetings to all. We are very delighted to have you with us today for this important workshop on the IFRS Sustainability Disclosure Standards, which is issued by the International Sustainability Standards Board. This workshop is, like Fiona mentioned, is a collaborative effort between the United Nations Sustainable Stock Exchange Initiative, Bursa Malaysia, and PACE, which serves as a support hub of the National Sustainability Reporting Framework. As many of you know, the Sustainability Reporting Framework, or NSRF, was launched on 24 September 2024. This framework addresses the use of the ISSB standards, specifically the IFRS S1, which is the general requirements for disclosure of sustainability-related financial information, and also IFRS S2, climate-related disclosures. And this will be the baseline sustainability disclosure standards for companies in Malaysia. This harmonization aims to ensure that sustainability information is consistent, comparable, and reliable. And ultimately, this strengthens Malaysia's competitive edge and enhances our attractiveness to global investors. The NSRF was developed by the Advisory Committee on Sustainability Reporting, ACSR, and is applicable to listed companies on both the main market and ACE market of Bursa. It also extends to large non-listed companies with an annual revenue of 2 billion ringgit Malaysia and above. The framework will be implemented in a phased and developmental manner for annual reporting periods beginning on or after 1st January 2025. To support the NSRF, the ACSR will focus on capacity building programs and tools to assist companies in using the ISSB standards. These measures will be implemented through an initiative referred to as PACE, P-A-C-E, which stands for Policy, Assumptions, Calculators, and Education, which serves as a hub for supporting the NSRF. PACE will, among other things, will conduct capacity building programs for companies. It will make available NSRF-related educational materials, guidance, toolkits, and an emission calculator. It will also provide granular help, and last but not least, it will also derive consensus on key assumptions and disclosures. And it is now our privilege to welcome esteemed experts from the International Sustainability Standards Board, or IFRS Foundation, and the UN Sustainable Stock Exchanges, or UNSSE, to share their invaluable insight with us. I would like to take this opportunity to invite you all to participate wholeheartedly in today's sessions. Your engagement is essential as we work together to improve on the quality of sustainability disclosures in Malaysia and promote transparency and accountability in our markets. I appreciate your efforts and look forward to a workshop that will be both productive and enlightening. Thank you, everyone.
Thank you very much, Dr. Hezri, for setting that excellent context to the session. And indeed, it's fantastic to hear about the great progress you're making in Malaysia in bringing forward the ISSB standards and really setting a fantastic example in doing so. So we really applaud you for doing that. And of course, know that there is lots of interest then in this content. So we're glad that we can support in delivering some training to support that in particular. Brilliant. So I'll just cover a few things in terms of housekeeping, in terms of how the session will run today, just so that's all clear for everyone. So you will probably have noted by now that you are muted. However, as you're already doing so, please make sure you use the chat function to share your comments throughout, and keep an eye out for chat messages from us as well, where we'll be sharing some relevant links for you to look at and some instructions as we go along. If you have particular questions for the team, please make sure to post those in the Q&A box, because that will just enable us to ensure we keep track of all those questions and the answers to them. So make sure to put any questions in particular in the Q&A box, as you have started to do so as well. So that's fantastic. We really do like to receive your questions, so please do answer them. We have lots of the members of the team on to help with answering them. If there's a question that's already been asked that covers something that you're interested to know, feel free to thumbs up the question so that we can make sure we're answering the questions that are the most popular as well. And then in terms of the format for how this session will be delivered, so we'll be doing 3.5 hours of live training today. There will be a short optional homework exercise as well that you can take away to continue to progress your learning. As we've mentioned, we'll have live interaction with you through the Q&A, and we will also very much encourage your participation in the session. So we'll be using Menti and the poll function within Zoom as well. So please keep an eye out for those participation opportunities, and we love to get your input through those. And finally, if you attend the session in full live, you will receive a certificate of completion as well that is CPD certified. To do so, you'll need to complete a feedback survey, which we'll be sharing with you at the end of the session, and which you'll be able to receive afterwards via email from Zoom as well. So we'll explain more about that later. Just to introduce who will be delivering the training today. So I am Fiona from the SSE Academy training team, and I also am joined by my colleague Lois Guthrie, who is a senior specialist in our team. We're then joined by our IFRS colleagues who, of course, are real experts in the S1 and S2 standards. So we have Bella Cheng and Robert Swiatowski, both joining us today. They're also joined by their colleague Jarlath Malloy, who is the Director of Strategic Affairs, who'll be supporting in the background with some Q&A as well. So thank you to all of the IFRS team for joining us and delivering together. Finally, we are supported continually by the IFC in this program of delivery. So we'd like to thank IFC and Relitsa Germanova in particular, who leads this program, for their support throughout this. So our learning objectives from the day are threefold. So we're going to just recap quickly what those are. So firstly, we're hoping that you will come away with an understanding of the ISSB standards. Secondly, we'd like to help you understand how to use the ISSB standards. And finally, we'll work to identify what steps can be taken to develop a disclosure plan applying the ISSB standards. So 3 kind of simple objectives, but we hope that those really start to build the foundations to enable you to take the ISSB forward within your own organisation. And to meet those 3 objectives, we've set out a structure to this training that aims to simplify this process and really take it step by step. So here you'll see the 4 pillars of activity that we're going to be working through as modules within this training session. So first module is prepare. So this builds on your existing knowledge of the landscape. So we're looking at what the purpose of reporting is, we're looking at how the landscape is evolving, and of course, what's led to the global baseline of the S1 and S2 standards. We'll then be moving into align, which is all about setting the direction for how to align to these standards. Sorry, just excuse me. A slight cold today, so I might just take a little bit of water here and there. So we'll be looking at really how you can align in terms of what disclosures you need to add to meet the requirements of the ISSB standards and adapt your existing reporting. We'll then be moving into implement, which is all about the practices and systems that you need to put in place or to adapt to support you in the reporting. And finally, we'll be ending on communicate. So thinking about how to share this information with your stakeholders, where you should be putting it, and how to do so efficiently. So to do this, we have the agenda that I am sharing on the screen now to work through. So this breaks out the session into a number of segments aligned to our modules. We will also have a short break around the midpoint of the session as well, just to allow everyone to refresh slightly. And as we've said, do feel free to keep asking your questions as we go along, and we'll be sure to answer those as best we can whilst we're doing so. Just to mention, all of the training materials that we'll be using in today's session can be found on the SSE's website on the event page for this session. That link will be shared with you in the chat. But yeah, if you do miss it, just because I know the chat's quite busy, if you go to our website and under Academy and then Workshops, you'll find the page for today's session where you probably registered to join us. So that page includes the handout from the slides here, and it also includes the homework assignment as well. And then after the session, we will be posting the recording there as well, so you can share that with your colleagues. And as I've mentioned, there is an optional homework assignment. It isn't mandatory to complete this or submit it, but it's really helping you to develop that draft disclosure plan to put into practice what you've learned in today's program. So this is really just about helping you to build on what you've learned today and to start taking this forward with your colleagues internally. So we hope that you'll find that useful as well. And alongside this training, we have a whole suite of resources in the SSE Toolkit, which you can find online, and we'll be sharing the link in the chat again to that shortly. So this goes into some further detail around the 4 units we're talking around today. So if there's any areas that you want to understand in more detail, you can look at those different resources available within the toolkit and make good use of those to support you in your learning journey. So in particular, we have a model guidance and a gap analysis checklist aligned to the sustainability related financial disclosures of the ISSB. And we also have 2 climate-specific tools on transition plans and on disclosing climate metrics as well. So make sure to take a look at those. Okay, so with that, we'd like to get you involved in your first interactive exercise and make sure everyone can access Menti. So a link will just be shared shortly with you in the chat box, which will provide you the link to go directly to the Menti exercise that we'll be doing together. So if you follow that link, when it comes through, we'll join together in Menti there. And Tiffany's also sharing with you now the Menti screen. So you have 2 further options to access Menti as well. Firstly, you can go to menti.com and use the code that is showing at the top of the screen there. And your third option is to use that QR code you can see on the screen as well. So I will just share that link again with you all in the chat so that you can see that. I see lots of you have made it into the Menti already, so that's fantastic. But yeah, our first question for you all, of course, was just to tell us a few keywords and sort of summarize what you're here to get out of today's session. Okay, I'm seeing lots of responses come through already, so that's been great to see so many of you able to get into Menti firstly. I'm seeing the word, there's so many words, it's quite small, but I can see learning, reporting, knowledge, disclosure. I see certificate coming through in the chat, of course. Compliance, understanding, sustainability, lots and lots of words. That's fantastic. Great. So I think we're all sort of aligned on what we're looking to get out of today's session and that focus on really understanding the standards. So that's fantastic. Thanks for completing that. So I think we'll move now into our next question. Thanks, Tiffany. And we'd just like to get a sense from you all as we start the session at where you're at with your current knowledge in these areas. So we have 3 areas of learning, as we've talked about already in the session. So have a little think in terms of from the scale on the left-hand side as not comfortable at all or very comfortable on the right-hand side, where you would say that you are at today with your understanding in these different areas of explaining the ISSB standards to your team, using them in practice, and in developing a sustainability reporting strategy. Great, so I see lots of you are responding to that. Lovely. So it seems as though we've got generally a distribution towards sort of the lower end of comfort towards middle. A few of you coming in who do have quite a lot of experience or understanding, so that's fantastic as well. But mostly we're coming out sort of mid to low comfort at the moment, which of course is very understandable given these standards are still quite new in the market, and you know, the disclosure requirements obviously have just been introduced for you in Malaysia as well. So that's fantastic. Thanks for letting us know that. Lovely. So I'll just get the slide presentation back up, but do keep that Menti link open because we'll be coming back to that throughout the session as well at the same link. So if you keep that window open in the background, that will just help you to get straight back in. Great. So now we're getting started with the training content itself. I'd just like to start with a quick disclaimer, just to talk about some of the examples that we're going to be mentioning throughout this session. So we include disclosure examples from certain countries, and these are very simply just to help add some color to what we're talking about. And sometimes, obviously, to bring to practice what we're talking about, seeing a real example can be quite helpful. However, it's important to note that these examples should not be seen as the best way or even the right way of reporting. And really that obviously for your company, your circumstances will be unique and the way that you should approach this will be unique to you. So just want to give you some inspiration and just make sure that's clear up front as we move through the session. Okay, so starting then with our first module, which I'll be kicking us off with before I bring in some of my colleagues as well. So here we're looking at building a solid foundation of knowledge. And this is really around building on what we already know about the standards and frameworks that are out there. So to build this solid foundation, we're generally looking to cover three important aspects. So first, we'll be looking at purpose. So what's the case for sustainability reporting, and including the market and business drivers that are sitting behind this. We'll then be moving on to landscape. So how has the reporting landscape evolved, and how is it simplifying in the introduction of the ISSB standards? And then finally, we'll be looking at the global baseline. So what are the core concepts and requirements within IFRS S1 and S2 that have formed that global baseline? So we'll get started first with the purpose aspect and looking at the particular case for disclosure and the market drivers. So to get us started with that, we have a Zoom poll for you, firstly, just to get a sense of what your drivers are for reporting. So the question you'll see come up is, what are the reasons for disclosing, what are your reasons for disclosing sustainability-related information? So let us know how many of those are correct for you. So regulatory drivers, sharing your own management objectives, perhaps peer pressure and benchmarking, investor interest, or maybe you have other reasons, or maybe you haven't disclosed yet at all, and that's fine too. So I see our responses coming through rapidly, which is fantastic. So I'll give you another couple of seconds to complete that. Brilliant, this is great. I mean, we have a lot of you here, so it's great to have a lot of numbers, but we also have a very high participation rate, which is great. So do keep that up. It's great to get all of your involvement in the session. So we're slowing off just slightly there. So I will end the poll now and I'll share the results with you. So it looks like we've got a bit of a spread, but maybe unsurprisingly, given our opening context, we have regulatory requirements obviously coming out top as a key driver for you all. But also it's great to see that there's a range of other reasons that you're coming to reporting. So investor interest and sharing your own management objectives also coming out highly. And perhaps some of you also feeling that pressure or competitor benchmarking as a need to keep up with what's going on amongst your peers as well. And of course, a few of you who are new to reporting as well, which of course is no problem and very much welcome to this area of learning. So that's fantastic to see. Thank you for sharing with us. Okay, so we'll just close the poll screen there and go back to the slide presentation. You may have to dismiss that on your end as well if it's just in the way of the slides for you. So we'll go then into a little bit of a context setting of what that purpose is. So we've talked there about investor interest being one of your key drivers, and that's something we see very much replicated across other markets. So we have now more than 5,000 signatories representing over 121 trillion US dollars in assets under management who are signatories to the UN Principles for Responsible Investment. So that really demonstrates the growth we have in investor focus, in particular on setting out responsible business practices and integrating ESG into their processes and decision making. But what is it that's really driving that investor interest? I think what is important to highlight here is that actually a key driver for investors is really the deemed potential financial effect of sustainability risks and opportunities. So here we're showing you a study of retail investors, which was done by Morgan Stanley. And what they found here was that for these retail investors, actually the primary reason for their interest in sustainable investing was actually wanting to consider it within the financial performance of their investments. So here you can see people from an investment perspective are really starting to understand that the sustainability risks and opportunities are very much financially relevant and have potential materiality to their investment decision making. So you can take a look at that study via the link, which will be in the handout materials we've mentioned already. But let's look a little bit closer before we move on as to what we actually mean by financial performance. So it's important to remember today that we're talking about disclosing financially material sustainability related information. So we're going to discuss more in depth in the workshop as to what we mean by material, but we wanted to be clear from the start what sort of financial effects investors are looking for more information on. So firstly, we'll start with effects on the company's performance, which we often see in the statement of profit or loss, which shows income/revenue and expenditure. Excuse me, just have a little bit of water. And so sustainability-related risks and opportunities can have a financial effect by changing the revenue mix or total revenue of a company if demand for products and services change or production capacity is disrupted. So we could here see substantial changes in expenditures if, for example, operating costs increase, maybe due to rising energy prices or the need to invest in further R&D to capitalize on sustainability opportunities, or perhaps other costs required to deploy new practices. We'll then also be talking today about effects on the company's financial position. So let's look at what that means as well. And we can often see a company's financial position on their balance sheets or otherwise their statement of financial position. So for example, a company might experience changes to certain assets or liabilities due to climate or sustainability issues. We could see changes to portfolio value, or we might even see write-offs of certain assets that are damaged or need to be repriced to reflect sustainability risks. And another financial effect that should be documented is changes to financing and the cost of capital. This could include, for example, insurance premiums that have increased due to climate risks, or perhaps making use of new financial structures such as green bonds or social bonds. So before we move into the next unit of the module, I just wanted to flag two really important aspects of sustainability-related risks and opportunities, which are quite key to understand for our outset at disclosures. So as you can see here from the latest Global Risk Perception Survey from the World Economic Forum, risks evolve over time. So something that might pose a risk 10 years from now might not be high on the mind today. And we can see that in these risks reflected in the report. So in the future, we see, for example, a lot of environmental risks coming up the agenda as much more material. And what's important for our disclosure is that we're preparing for those risks that we're expecting to arrive in perhaps 5 or 10 years, but that actually we might have to invest today in new practices or processes to take those mitigating steps, or indeed to capitalize on opportunities. So actually, although a risk may materialize over the longer term, the financial effects could occur in the much more near term. So that's something to keep in mind when we're thinking about the content in today's session. And another important aspect of sustainability-related risks and opportunities that we wanted to highlight is their interconnectivity. So this visual also comes from the same World Economic Forum report. And as you can see here, there are many connections between different risks. So many people might think of the two ISSB standards, S1 and S2, as separate standards, one for climate and one for other topics. However, as you can see on the slide, all sustainability-related risks and opportunities are interconnected. And so separating out one topic or theme, of course, doesn't remove these interconnections. And we really have to try and think in a holistic way when we're making decisions on these issues. And this, of course, is similar to the way we deal with many risks and opportunities, that we should be looking at that interconnected lens. And of course, you'll find that sustainability risks are likely to connect to many of your existing business risks as well, related to geopolitics, technology, etc. So when we're disclosing information about these climate risks and opportunities under the S2 standards, you of course need to be thinking about applying the requirements of S1 as well. So for thinking climate risk, we also think about the connection to other sustainability risks. Excellent. So that covers everything on the first segment on purpose. I'll now hand over to Lois for our next section on landscape.
Thank you, and hello everybody. We've looked at why sustainability disclosure is important and why some provisions for disclosure have been developed, but we're now going to look at how the IFRS sustainability disclosure standards have been developed within the landscape of existing reporting standards. But first of all, before we begin, we just wanted to check with all of you what frameworks you're currently using for sustainability disclosure. So we're going to launch a poll for you and invite you to select all that apply from the frameworks that you're currently using. So these could be CDP, the Carbon Disclosure Project, GRI, the Global Reporting Initiative, the Integrated Reporting Framework, the Sustainability Accounting Standards Board standards, the recommendations of the Task Force on Climate-Related Financial Disclosure, the UN Global Compact Principles, or any others, which it would be great if you could indicate in the chat. We can already see many people responding that they are using the Bursa's standard sustainability reporting requirements that Dr. Hesri described at the beginning. Great to see so many of you participating here. Now we've got nearly 60% participation. I'm going to end the poll and share the results. And you'll see that the majority are using the Global Reporting Initiative standards, followed by integrated reporting is the next most popular. Oh, the TCFD is the next most popular, Task Force on Climate-Related Financial Disclosure. Then there's about 30% of participants using integrated reporting, and the others not quite so well represented. So thank you for telling us about that and for all your responses in the chat about the different disclosure requirements that you're using. FTSE for Good, we see there, local rules to Pakistan, and of course the requirements issued by Bursa Malaysia coming through quite a lot. So thank you very much for that. We're going to move on now to look at the structure of the IFRS Foundation. So the standards that we're going to be talking about today were issued by the IFRS Foundation, which is a not-for-profit public interest organisation established to develop high-quality, understandable, enforceable and globally accepted accounting and sustainability disclosure standards. So the IFRS Foundation hosts two independent standard setting boards. The International Accounting Standards Board, formed in 2001, sets financial accounting and reporting standards, and those standards are in place in over 140 jurisdictions around the world. The International Sustainability Standards Board was formed in 2021 and released its first two standards in 2023, IFRS S1 and S2, and this was done following strong market demand for the establishment of the ISSB. The two boards work closely together. Governance of the boards is provided by the IFRS Foundation trustees, and they in turn are accountable to a monitoring board of public authorities. So how did the standards evolve? Well, they evolved based on the work of the logos and the standard setters that are represented by the logos that you see on this screen, and many others, of course. So all of these organizations represented by their logos have contributed to the evolution of sustainability reporting. The organizations have a lot in common, but they differ in terms of their objectives and guidelines, and sometimes the number and range of organizations and standards gave rise to confusion in the market and were sometimes called an alphabet super standards. And most of the organizations you see on the screen focus on meeting investor needs for sustainability, except GRI, which, as I'm sure we all know, supports a broader range of stakeholders. But from this slide, the main message to take away is that it's a picture of simplification and harmonization. So you can see from the arrows that point towards the IFRS Foundation that the work of many of these organizations has been consolidated into the IFRS Foundation and forms the basis for the IFRS Sustainability Disclosure Standards. So the standards were built on the architecture and much of the content of the TCFD recommendations. So those of you following who have been reporting in line with TCFD will find the IFRS Foundation standards are very familiar. The TCFD's work now, as you probably know, has finished, and the TCFD has been disbanded. The IFRS Foundation has taken over the disclosure-specific materials and aspects of the work of the Transition Plan Task Force. We see at the bottom of the screen here the three organizations whose work has been consolidated directly into the ISSB standards, including the Integrated Reporting Framework, SASB, and the Climate Disclosure Standards Board. CDP has aligned its climate questionnaire with IFRS S2 climate requirements, and GRI and the IFRS Foundation are working very closely together to ensure that they jointly identify and align common disclosures. So very simply, a picture of simplification and harmonization, work on which is ongoing to maximize that harmonization. So let's go now into Zoom poll 3 to think about the effect of this consolidation. So the question that will pop up in the Zoom poll is, and you can only answer one here, single choice: companies who disclose using the TCFD recommendations automatically comply with the ISSB standards. Is this true or false? Great participation here. We have 60% of you, so I'm going to end the poll and share the results. So 52% said it was true and 48% said it's false. So the participants we have here today are quite evenly divided in their answer. The correct answer is false. I can completely understand why some of you said true, because of course the work of TCFD has been consolidated into the ISSB standards. But so those of you that are using TCFD, you will find that you already have a very good basis for understanding IFRS S2. However, there are some small differences, small but significant differences, and that's why the correct answer is false. So if you are currently using the TCFD recommendations, you cannot assume that you automatically comply with the ISSB climate standard, but you will be a long way towards that compliance. So let's have a look at this in a bit more detail about these differences. The first thing to note from the little picture on the left here is that the ISSB has issued a document that explains the differences between S2, the climate-related disclosure requirements, and the TCFD recommendations. So we know that TCFD culminated its work in July 2023, and the IFRS Foundation has taken over responsibility. And the differences that are described in this document explain that sometimes it's just a case of the ISSB using different wording, but to capture the same information as the TCFD. In other cases, it's that IFRS S2 requires more detailed information about things like the use of carbon credits, or that S2 has additional requirements, including things like the requirement to use industry-based standards in developing some disclosures. So let's move on now to look at the objective of the ISSB. Their objective was to develop a global baseline for sustainability information that would enable comparable and consistent sustainability disclosures across capital markets. So the foundation is working with jurisdictions around the world, as well as other stakeholders, to achieve this. However, the little symbols that you see above the dark blue box are there to signify that building blocks can be added to the global baseline, and they can be added by regulators, stock exchanges, and others who want to add disclosure requirements tailored to the needs of the jurisdiction or to specific audience needs. So additional disclosures can be required as long as the information is presented in a way that doesn't obscure the required disclosures in the global baseline. So these building blocks could involve disclosures that go beyond the investor-focused remit of the ISSB standards. So, for example, some of the information from GRI standards or jurisdiction-specific information requirements could be added as building blocks to the global baseline. So taking this building block approach reduces the need to duplicate information by having that globally consistent baseline of disclosures, while still allowing jurisdictions and others to report additional information based on standards like the GRI standards. Just to say briefly here that there's been global backing for this approach. The global baseline is represented by the standards that the ISSB issued in June 2023. The International Organization of Securities Commissions announced its endorsement of the ISSB standards and have asked their 130 members to consider how they can incorporate ISSB standards into their regulatory frameworks. The Foundation is working with others who can support the adoption of the ISSB standards and their use. For example, the International Auditing and Assurance Standards Board, who's recently approved an assurance standard for sustainability information. As part of its regulatory implementation program, the Foundation is supporting multiple jurisdictions with planning and preparation for voluntary and mandatory jurisdictions. And the Foundation is also working with stakeholders around the world who are working voluntarily to apply the standards. So I'm going to hand over to our colleague Bella now, who will tell us more about the standards.
Thanks, Lois, and hello, everyone. Let's continue. Yes, we've talked about the business case and the market case for sustainability reporting, the evolution of the landscape, and how it is being simplified and rationalized. Now let's introduce IFRS S1 and S2. And also I've seen some attendees to ask questions about details of S1 and S2. So we will cover this in details now. Okay, so as we start, it's important to know that there are some key terms that should be understood. You can find the definitions in your handout, but I wanted to briefly mention them here. First of all, we will be saying the phrase sustainability-related financial information quite a lot. This can refer to a broad set of issues, including climate, nature, or biodiversity, human, social, or others. And what is sustainability-related financial information? It is information about a company's sustainability-related risks and opportunities that is useful to investors in making decisions about providing resources to the company. Sustainability-related risks and opportunities are those that could reasonably be expected to affect the company's cash flows, access to finance, or cost of capital. For example, it could affect the company's prospects. So we will also often refer to general purpose financial reports, which includes a company's financial statements and the management commentary. You might know this as a management report, management review, or strategic report. Some regulators require specific disclosures in certain parts of general purpose financial reports, so we use this generic phrase in this session. Okay, so anyone familiar with TCFD will recognize the same 4 core pillars or content areas for the ISSB standards. These are governance, strategy, risk management, and the metrics and targets. For each core content area, there are a set of key disclosures to be addressed, and the standards provide very detailed guidance on these requirements. We will discuss each of the 4 content areas today, but I encourage you to download the standards as part of your homework assignment. Okay, now let's start with IFRS S1. Its full title is General Requirements for Disclosure of Sustainability-Related Financial Information. IFRS S1 sets out general requirements for the content and the presentation of sustainability-related risks and opportunities. If you are familiar with TCFD, you will see the same architecture applied through all the standards. S1 asks preparers to refer to and consider the applicability of the ISSB standards and the other sources of further guidance to identify sustainability-related risks and opportunities, and identify material information. The ISSB standards are organized by industry, enabling a company to identify disclosure topics and metrics applicable to its business model and operations. Finally, the standards can be used in conjunction with any accounting requirements. The scope of S1 is all sustainability topics except for climate, which is covered by S2. So the second standard, S2, focuses on climate disclosures, building on the same foundations of S1. For example, it fully incorporates the recommendations of TCFD, and it sets out the requirements for a company to disclose material information about its climate-related risks and opportunities. And also, it requires the disclosure of both cross-industry and industry-specific information. In terms of climate-related risks, these include both physical and transition risk, which we will come back to later. Other specific climate-related disclosures are required, for example, on scenario analysis and the GHG emissions. Preparers must also refer to and consider the applicability of the industry-based guidance on implementing IFRS S2. As we've said already, this is organized by industry, enabling a company to identify climate-related disclosure topics and metrics applicable to its business model and operations. So now let me talk about these slides. IFRS S1 and S2 are not standalone standards. They are a package and must be applied together. Even when a company is reporting only on climate-related risks and opportunities, the company must apply both IFRS S1 and IFRS S2. This is because S1 sets out general requirements or parameters for the type of information that needs to be provided in order to be decision useful for investors. S1 also explains the concept of materiality and how companies identify material sustainability-related financial information. Next, let's consider some of the conceptual foundations that underpin the ISSB standards, which might be new to anyone without an accounting background. These concepts help us to understand how best to disclose information in order to meet the requirements of the ISSB standards. To start with, companies must fairly present a complete set of sustainability-related risks and opportunities. Fair presentation also requires disclosures to be faithfully represented. To achieve this, companies shall provide a complete, neutral, and accurate depiction of sustainability-related risks and opportunities. The reporting entity concept requires the organizational boundary for sustainability-related financial disclosures and financial statements to be the same. Another important concept is connected information. We saw earlier when Fiona explained how different risks are often interconnected. The ISSB standards require companies to clearly identify key connections, such as those between risks and opportunities, connections between the 4 content areas, and connections between sustainability-related financial disclosures and the main financial statements. Now let's look at an example, and over to you, Louise.
Thank you, Bella. And before we go into the example, may I invite you to remember, please, the disclaimer that Fiona gave us earlier, that any and all examples that we explain today are just here for inspiration. They're not to represent best or good practice. They're just for inspiration and illustration. So the first example is from the 2023 annual report of a company called BHP, which is a global mining company. And this example is given to illustrate some of the connections that a company has made in this company has made in its report. So in this particular case, it illustrates the connections between the company's decarbonisation strategy and its financial results and other processes. So let's have a look. What in particular do we see being connected? First of all, the decarbonisation strategy is connected with the investment process and the company's decision-making. So in the first paragraph, we see that BHP says all investment decisions consider the quantity of greenhouse gas emissions associated with the project, the cost per tonne of CO2 equivalent associated with the project, and the alignment with the group pathways to a net zero trajectory. So they're telling us we have this pathway to net zero trajectory and we take it into account when we make our investment decisions. Secondly, they connect the decarbonisation strategy with types of expenditure now and in the future. So you can see in the second paragraph that they spent $122 million on operational GHG emissions reductions in the reporting year. But we can also see in the third paragraph that the company anticipates more spending until 2030 in the region of $4 billion. So that's the second connection, the decarbonisation strategy and expenditure now and in the future. Lastly, we see the connection between the decarbonisation projects and net present value. So they say in the penultimate paragraph, based on current assumptions, the achievement of medium-term targets is expected to deliver positive net present value for the group, as it has done on already implemented projects. So the final thing to notice about this example is the orange text at the bottom of the extract tells us where the reader can find more information on the range of investments the company has to drive decarbonisation and sustainable growth. So it's a little navigation tool that they use in the orange text. So we're just going to go on to another Zoom poll now. And it's over to you, Bella, to lead us through this.
Thank you, Lois. Yes, now we're going to have another Zoom poll. This is a question related to connected information. What information should be considered for connected information? Connections between governance, strategy, risk management, and metrics and targets, or sustainability-related financial disclosures and financial statements, or sustainability-related risks and opportunities. Let's just wait for a few seconds. I'll choose all the answers that you think is right. Okay, so we already have almost 70% participant. So I'm going to end the poll and share the result. Okay. Yes, well, just remember that we said earlier, the connected information, there are three perspectives, which are four core content areas, sustainability related financial disclosures and financial statements, and also connections between risks and opportunities. So all the answers are right. And I think most of us have done correctly. So let's continue. Okay. Well, finally, the standards are built on the concept of materiality as defined by the IFRS Foundation. We are going to go into this in more detail later, but just to highlight that we will be referring today to material information, which is information that, if omitted, misstated, or obscured, could reasonably be expected to affect investor decision-making. During the ISSB consultation on the exposure drafts, one of the key feedback topics was the importance of supporting preparers, particularly those with more limited resources and those in emerging markets. In addition to the standards and the application guidance published in 2023, a number of educational resources were also published, and since then others have followed, including the IFRS Knowledge Hub. We are also in the process of gathering examples and case studies provided by our partners. The ISSB standards were aligned with IFRS S2 to help preparers seeking industry-based guidance, and the FSA credential was also updated with more planned to come. I should also note that the IFRS Foundation's Capacity Building Program, which is launched at COP27, is a key part of our support to preparers, and the ISSB training initiative is one of our most important deliverables. Yes, next, there's another Zoom poll. Yes, the question is, yes, water is a vital input to our business, but the ISSB standards do not currently have a specific standard on water. What do we do? And please notice that this is a single choice, so only one correct answer. Option A is do not disclose anything about water. Option B is consult the sources of guidance listed by ISSB. And third one is engage a consultancy to help. And the fourth one is copy your competitors' reporting. Yes, now we have over 60% participation. So I'm going to end the poll and share the results. Well, most of us have done correctly, and the correct answer is B, consult the sources of guidance listed by ISSB. Just remember that we mentioned earlier, according to the requirements of S1, there are certain guidance that you shall refer to. Yes, but well, for this question, the correct answer is B. But sometimes maybe you think the option C and option D may be helpful. But for this question, there's only one correct answer. Okay, so let's continue. So I'm going to hand over to Fiona for the next session.
Thanks, Bella. Brilliant. So that brings us to the end of module 1. So before we wrap up this module, we're going to take a few minutes just to recap on what we've learned so far. So firstly, we reviewed the purpose of sustainability-related disclosures. And a key takeaway we're really hoping that you come away with from this workshop is that there are important benefits both internally and externally for collecting and disclosing sustainability-related financial information. So although I know, as many of you have told us, regulatory drivers, including the Bursa requirements, are a big driver behind your reporting, of course, we want you to make good use of this data. And if you're not making sure that you're using that information that you're collecting to improve your strategic decision-making, that's a real lost opportunity. So we'd really encourage you to embrace that mindset. Also, if you have operations in hard to abate or high impact sectors, your competitors may well already be disclosing risks and opportunities that they're pursuing. And so if you're not doing the same, it's going to leave your investors wondering why you might be lagging and not assessing these issues and managing them. And ultimately, in the long run, that might affect your ability to access capital. Next, we then looked at the evolution of disclosure standards and the formation of the ISSB with the aim to simplify that reporting landscape. So when you're thinking about your other voluntary disclosures, you shouldn't see them as competing with the ISSB standards, but rather building on top of them. And finally, we introduced the standards themselves and the important concepts that you need to understand in order to use them correctly. And a key point I want to reiterate here is that these standards and the guidance that comes with them are designed to meet the needs of investors as the primary user. And so they are heavily focused on the prospects that we discussed at the start of this unit relating to financial effects, financial position, and risks and opportunities associated with that. Great, so that recaps the session so far. So now we'd like to move back into another Menti exercise. You should hopefully have Menti open from previously, but we will shortly reshare the link again with you so that you can navigate back to Menti if you have closed it. But our first exercise is really asking you to think about what you're going to do to build that capacity in your organization and go about identifying what the skills and knowledge gaps are that you might have. So some things to think about here will be around setting that real tone from the top in terms of identifying the leaders in your organization who are going to provide oversight, thinking about how you're going to integrate this information into what your existing teams do, or perhaps you might even need to negotiate a little with your colleagues to secure resource and buy-in. So I'll just ask Tiffany to share the Menti screen. Thanks, Tiffany. And I see we've had Lois reshare the link in the chat as well, so that's brilliant. And it looks like lots of you have found your way into the exercise already, so that's fantastic. So let's just see what's coming through. So we have here ideas around having a gap and just scroll back up. Yeah, sorry, gap analysis, or a SWOT analysis indeed. So enrolling in training, I must learn and gain knowledge. So attending trainings, of course, being assisted by a consultant, joining the workshops, training and sharing with the team, engaging sorry, I've lost that one. Engaging, thanks. Engaging a professional to assist with the assessment and use the guidance, understanding the applicability, studying the details of the guidance itself, of course, and developing tools, bringing consultants, engaging your board, absolutely getting them on board early is really important. And I think a lot of good advice here around looking at the standards themselves, of course, as the source of your gap analysis and using the structure. There's no better place to start there. But indeed, surveying your colleagues and stakeholders to understand their expectations or their knowledge and what they can support on is great. Enrolling in trainings, we've had several times again. So of course, we're glad that you're all with us here today, and we'll be recording this and sharing it so you can share that with your colleagues too. Conducting a gap and setting up a task force. Yes, absolutely. Getting some dedicated resource to focus on this and put in place a plan together. Recruit the HR team to do this. Oh, that'd be lovely if you could get them to do it all, wouldn't it? But I presume maybe we're talking there about using your HR colleagues to think about the skills gaps. Exactly. So they have those capabilities to think about what actual skills that you need. And that's really useful to remember that you can draw them in to help thinking about competencies, structures that will be most effective here. And again, I think this is one where there's no right way. So really, in terms of organizational structure, it will depend on what the right way to integrate and deliver this is for you. So we've had several people say about engaging professionals, of course, getting that expert recommendations, doing a materiality assessment, as we've seen mentioned a few times, is really important to help you identify what are those material risks and opportunities that you'll need to disclose upon. From the financial investor perspective. Gap analysis, yep. Strategize on upskilling myself for the team and have a smooth transition. Yes, exactly. We have to start with ourselves. So whilst we don't want to put all the pressure on ourselves individually to deliver this, we need to be in a position to effectively guide others on the requirements. So that's definitely a good place to start. We have looking at peer practices. Yes, exactly. So we'll be sharing some examples here today that we hope will help you to start thinking about that, and you can look to for further inspiration. Lots of ask my boss. Yes, if your boss will know the answer, that would be lovely. But indeed, making sure that you're flagging up the additional requirements that this may bring and the resource that you need for it. Engage with me. I'll do my best to help. Need to learn what the standards are, surveys, more training. Great, lots and lots of answers coming through here. I'll just see if we have, I think we've covered a few of these already. Building consensus, as you say there, is important so that we make sure we're all clear why we have to do this, what we're going to be doing. And indeed, I think negotiating, as we see mentioned here, may be important within that. Operationalizing ESG, yes, we're going to come in to speak about that a bit more later in the session. Brilliant. And maybe setting yourself some indicators, as you said there. So, yeah. We're going quick, but I'm not seeing anything particularly different come out, so I think we'll pause there, but lots of really good thoughts there, so thank you everyone for sharing with us. And so fantastic to get you already thinking in such an engaged way about what the requirements are. Great, I will just move us back into the presentation. And then thanks for wrapping up that module so well with your thoughts. I'll hand us back over to Bella now to start on our next segment.
Thanks, Fiona. Okay, now let's continue. We have introduced the initial concepts. Let's dive into how to apply the ISSB standards, taking into account additional disclosure, including any relevant geographical or sectoral requirements, as well as peer practices and your leadership's objectives. In order to understand how to ensure your disclosures meet global standards, we will look at two key concepts in this unit. The first and the main focus of this unit will be on how to apply the standards to achieve a global baseline for disclosure. Once we cover that, we will also discuss how additional disclosures fit. To begin with, let's focus first on how to apply the ISSB standards as the global baseline. Okay, so now let's get started on the first core content, governance. This includes aspects that relate to the governance body in your company and how management is applied. For each of the core content areas, we will discuss questions that you could ask in your company to start identifying the information that will support some of the disclosure requirements, for example, as part of a gap analysis. So if we look at the governance and the management requirements, we can see that there are several that are fairly qualitative. For example, which bodies are responsible for the oversight and the management of processes, controls, and the procedures of sustainability-related risks and opportunities. And for example, is management responsibility delegated to a specific role or committee? And how and when do they get informed about sustainability-related risks and opportunities? How these issues inform strategy, decision-making, and risk management. This could include setting targets to manage sustainability-related risks and opportunities. And finally, whether progress against these targets links to executive remuneration. For more information, you can make use of the SSE checklist tool, but remember it's not a replacement for reading and using the full ISSB standards. The next, another example, and now I'm hand over to Lois.
Thank you, Bella. This example is from AIB, which is a high street bank in Ireland that has some great sustainability credentials. And this describes their governance model. Now, of course, as you know, there are many ways in which the governance model can be explained and many ways in which organizations can choose to set up their governance structure. So this is just one of them. And it's from the 2022 annual report of AIB, and they have since updated this. But basically what you see here is in the governance model, there are 3 board committees. So as Bella just said, the IFRS S1 does ask for companies to explain who is on, what is their board committees and how are they set up. So there are 3 board committees for risk, Sustainable Business Advisory Committee, and the board Audit Committee. So each in turn is supported by an executive subcommittee and management. So in this case, you see the demarcation between audit, risk and sustainability, including the split between responsibility for financial and non-financial disclosure. So that's the way in which AIB describe their governance structure. Let's have a look now at another example, and this example is from Toyota, who I'm sure you know is a car manufacturer. It's from their Sustainability Data Book 2023, and it's actually set out in the way that was recommended by the TCFD. But what we see here really gives the information that the ISSB standards want too. So the first thing that we want to draw your attention to is that we see what is the role of the board, what are their responsibilities. Their duties are to deliberate and supervise strategies, major action plans and business plans, to monitor progress towards qualitative and quantitative targets addressing the issues. So we know what their role is. The second thing we want to point out about this example is they say what the board has done to inform strategy. So they tell us that the governance mechanisms were used in formulating the company's long-term strategy, including the Toyota Environmental Challenge 2050, and in formulating and reviewing the medium to long-term targets and action plans associated with that long-term strategy. So thirdly, last thing to note about this example is they tell us what actions and decisions the Board of Directors have taken in their 2022 meeting. So they reported on and improved the identification of carbon neutrality as a key matter in relation to climate change and the development of a plan to transition to carbon neutrality by 2050, and also made a resolution about the level of battery-related investment they should take. So two examples that tell us how two different companies have approached their disclosures to governance. And as I said, these have since been updated. So handing back to you now, Fiona, to take us through strategy.
Thanks, Lois. Great. So now with those examples kind of covered off, we will be moving, as Lois said, into the strategy module. So hopefully that's made it fairly clear how governance works. With strategy, there are, however, a few more components to the disclosure, perhaps, that bring a few more complexities. So we'll take some time now to go through what those are. But really, we'd like to highlight as well that the strategy pillar is where companies can see the real benefits from sustainability risk and opportunity management. So we'd encourage you to try and embrace it with that mindset as you can. So as you can see here, there's three high-level aspects to strategy. So we have the risks and opportunity disclosure, we have consideration of the effects of those risks and opportunities, and then finally we have resilience. And we'll take each of those now in turn. Before we do so, though, we wanted to start again with some questions to consider. So really, the disclosures on strategy are designed to enable your users of the reports to understand your strategy for managing sustainability risks and opportunities. So if we look at those considerations, when disclosing information on risks, you're required to provide a description of the effects, the time horizons under which those effects are expected, and keeping in mind, of course, that the time horizons under which the financial effects could occur might be before the risk or opportunity itself materializes, or indeed afterwards, and that can also change over time. And the last two questions on this list in particular look at climate. So this aligns with the requirements of S2. So for example, if investors also want to understand what types of risk or opportunity we're seeing, we also often see companies here using the categories of physical and transition risk, drawing from the TCFD. And both of the standards include guidance to support companies in identifying and disclosing risks and opportunities, for example, by using industry-based guidance or the ISSB standards. So again, this can often be easier with an example. So let's look at another example here. So here we have Goldfields Integrated Annual Report. Goldfields is a diversified gold producer with mines in South Africa, Australia, Ghana, Chile, and Peru. And in the extract on the slide, we can see which risks the company has identified, how they've identified them using a prioritization matrix, and how those risks align with the strategic priorities that they have, and what mitigation policies they've put in place. So they provide a lot more information about these particular risks within their report. But I think what's useful to see here is that they have color-coded the risks according to their alignment to their strategic priorities. So you can see how they're really thinking about connecting these issues into their core strategy and addressing them in an integrated way, which is helpful to see. And another aspect of the risks and opportunities we identify as having a potentially financially material effect that will need to be disclosed brings us back to what we talked about at the beginning, and that is time. So you might remember we talked earlier that the time factor is something quite different when we're talking about sustainability risks and opportunities. So let's make it clear what we mean here. So the standards ask you to identify within what time horizon any material effects are expected to occur. And definitions of short, medium, and long-term time horizons will vary between companies and depend on many factors. So this might depend on considerations such as your investment and business cycles, your strategic planning horizons, or the life of your assets, or even other factors. And of course, that's going to vary depending on the nature of your industry and what sort of time horizons make sense for that. So it's important to remember here that whilst there isn't a set time horizon you need to use, you do need to make sure that you define a quantitative time horizon that you're using for your organization. So don't assume that investors will know what you mean by short-term, long-term, etc. You need to make sure that you've clearly stated that within your reporting. So we'll move on now to look at the second grouping of disclosures in the strategy category. And the first section we talked about there was identifying the risks and opportunities that might be expected to reasonably impact the company's prospects. And the next set of disclosure requirements focuses on what exactly that effect is and where it occurs in the business. So to start tackling the disclosure requirements of the standard, companies might want to start asking themselves questions such as beginning to describe these effects and understanding the response planned for mitigating or adapting to the effects. So again, let's look at an example here to help bring this to life. So this example is from the global chemical company BASF, and this company acknowledges that their strategy is affected by a number of ESG considerations, including climate change, scarcity of natural resources, pressure on ecosystems, and a growing population. And we discussed in the first set of questions on strategy, they were able to show which risks and opportunities in particular they expect will affect their company. But furthermore, what's useful is that they go on to explain these effects. They say that their business in the chemical sector has actually got a key role to play in addressing those challenges identified. For example, through innovation, through more efficient use of raw materials and reducing waste, and also through enabling healthy food production and climate-smart mobility. So as well as the changes that they hope that the chemical sector can offer society to respond to those challenges, the company itself is also going to need to undergo profound changes to respond to those trends. And these transformations are going to need to happen across their value chain. And as they show in the excerpt we include here, they see them looking across the supply chain, their production, and products that will be affected. So again, I should say that we just include a small extract from the report here, but we do encourage you to follow those links in the handout to look at more detail around how they disclose this in an integrated way. So sometimes one of the obstacles that companies face when they're reporting on these effects is what detail they should be disclosing. And of course, in that example we just looked at, we were mostly showing qualitative information and descriptions. But what about quantitative disclosures? So a company is required under the standards to disclose both quantitative and qualitative information about the current and anticipated financial effects of sustainability risks and opportunities. However, the standard does set out some criteria for when only qualitative information is required. So using only qualitative information for current and anticipated financial effects is permitted under the following circumstances. If a company can't separate the effects of a climate-related risk or opportunity from other effects, if there's a high level of measurement uncertainty, and additionally, if the company doesn't have the skills, capabilities, or resources to provide that quantitative information. So that brings us now to the last part of the strategy component. The first part there we looked at was risks and opportunities. The second part was what the effect of those risks and opportunities would be. And now this group of disclosures looks particularly at how the company is preparing for uncertainties and ensuring its resilience for the future. And this really gets into the practices and processes that a company has in place to assess its own resilience and make strategic adjustments where needed. So disclosures here include information on what types of assessment have been used and how scenario analysis in particular has been employed. And at the heart of it, resilience disclosures ask the company to think about how it is assessing its climate resilience and the inputs and key assumptions that are used in this analysis. So we'll dive deeper into scenario analysis in a moment, but some questions that you can consider asking internally when you're starting to disclose this information would focus on your company's capacity to react or adjust to those uncertainties and how you're going to use different scenarios to test this. So whilst scenario analysis can evolve over time into a more quantitative exercise, a simple starting point is to ask yourself, what if those different risks or opportunities materialize, and what factors are at play to consider in that assessment? So again, we're going to look at a couple of examples here just to bring this to life. So in this first example, we have Stora Enso, which is a Scandinavian forests product company. And here they show us in the small diagram on the top right of the screen, what they're expecting their sales to look like in 2030. So here Stora Enso distinguishes between their current essential business areas and their growth businesses. And they project out to 2030 what they expect their sales could be in the future. And we don't have any numbers here, but we have an immediate picture of where growth might be anticipated, and also some details about what the company's long-term vision is. And they describe here as well the transition that they are making to proactively position their business from being a largely pulp and paper-based company to focusing more on renewable materials and ensure their own future for years to come. So this gives a real sense of actually how they're seeing a real opportunity to grow through embracing that transition and what they're thinking about doing in the near term to adapt to that, for example, through converting their machinery and through investing in innovation required to realize that growth. We then have a second example from Solvay, which is a Belgian multinational chemical company. And here we're using this example in particular to illustrate how they report on the financial effects. And in particular, we want to look at here how they're being transparent about the estimates that they use. And note that they have developed these estimates and assumptions based on scenario analysis, which of course is a very useful tool to assess those financial effects, but not the only tool that could be used. However, if you are using a scenario analysis tool, investors of course need to know how you've used it and how you've reached those conclusions on potential reasonable financial effects. And you can see in this excerpt that they note the assumptions that they've employed, indicating which tool that they've used from a leading consulting firm to identify those assumptions in their assessment. And they also highlight that they have internal experts who've worked together with that consultant to conduct the assessment. And then on the second half of the screen here, we have a particular example from one of their business units relating to soda ash. So soda ash is a key ingredient that goes into lots of products, including windows, rechargeable batteries, and detergents. It's something that the founders of Solvay actually invented. But the challenge in the modern day era is that it's actually a very carbon intensive material to produce. So Solvay is working to understand how it can continue to produce soda ash, but do so in a more sustainable way. And here, the key thing that they're looking at in their analysis is actually thinking about how the cost of raw materials in the future could impact their margins. So they suggest actually under a 1.5 degree scenario, it could decrease their margins by 16% due to the changes in demand there. So actually it shows that if they can respond now and take action to improve the efficiency of how they manufacture that product, that actually that's going to give them potential to improve the margins and lessen that impact in the future. So this really shows, you know, the steps that they're taking to think about that and follow it through within their business activities. So I think that's quite helpful. Okay, so to close out this section, we have another poll question for you here, which I will just launch for you. So the next question is, a company can may choose to disclose only qualitative information and or combined quantitative information about current and anticipated financial effects when. So please choose all that you think apply as kind of permissible reasons for disclosing qualitative or mixed information. So that's either if they cannot separate the effects of a climate risk opportunity from other effects, if there's a high level of measurement uncertainty, or if the quantitative information sheds a negative light on the company. So I see lots of responses coming through, but I'll just give you another few seconds to let us know what you think are the right options there. Okay, that's great. I see lots of responses, so I don't want to cut you off too soon. I'll just give another 2-3 seconds and we'll close there. Thanks, everyone. So brilliant. I think, yeah, the vast majority of you have got this absolutely right. So the first two, A and B there, are both acceptable reasons why you might provide initial quantitative disclosures or perhaps provide a combination of quantitative and qualitative information about financial effects. And as most of you correctly identified, the third option there is not considered a permissible reason. So it's important that reporting has balance and provides fair and transparent information. So of course, that means that you should still be disclosing information on financial effects, even if those effects will be a negative impact. So, you know, in the example that we just saw from Solvay, that's the sort of disclosure they are starting to provide. But, you know, in doing so, as we said, that gives you the opportunity to demonstrate how you are going to manage and potentially offset that effect, and gives your investors the confidence that you are taking action on it, rather than wondering perhaps what you're doing about the topic if you're not saying anything. Lovely. Thanks, everyone. So I'll close that poll down and I'll hand back over to Lois now.
Thank you, Fiona. So we're going to turn now to look at some of the climate-specific considerations of the strategy requirements. Now, the governance requirements in S1 and S2 are very similar. There are no specific additional requirements for climate. They follow the same architecture and structure. However, when disclosing information related to strategy, there are some additional requirements in relation to climate. So we're going to have a quick look at those now. Now, as we have said before, the ISSB standards are based on the work of the TCFD, particularly in relation to climate. So the title here is from TCFD to ISSB, but don't worry, if you have not used TCFD, the list of points we're going to go through really tell us about what we find in IFRS S2. So the first point is that a company is required to refer to and consider the applicability of industry-based disclosure topics. Now, the thing to note here is that in S2 is accompanied by two documents. One is the industry-based guidance on implementing climate-related disclosure, and there's also some accompanying guidance on climate-related disclosure to help. But briefly, what this means is that when identifying climate-related risks and opportunities, and when defining metrics for climate risks, industry-based disclosure topics and the associated metrics should be looked at in the documents that I have described. The second thing to note about S2, when we compare it with S1, is that it requires more detailed information about where in the company's business model and value chain risks and opportunities are particularly concentrated. So this might apply, for example, where there is a physical risk to facilities in a particular geographical area, or it might apply to particular markets and products or parts of your supply chain. Thirdly, in describing the effects of climate-related risks and opportunities, S2 asks for a company how it has responded to those effects, to the effects of the identified risks and opportunities. Has it responded by developing a transition plan or metrics and targets, or taking mitigation or adaptation measures? Then, in providing disclosures about the current and anticipated effects of climate-related risks and opportunities on the company's financial position, performance, and cash flows, S2 sets out criteria for when quantitative and qualitative information is required. So disclosure of qualitative information only is permitted under some circumstances, for example, where a company cannot separately identify the effects of the risk or opportunity, or when the level of uncertainty about the measurement is so high that the quantification is impossible. So the standards recognize that some of these requirements are very difficult to conform with, so we'll talk about this in a bit more detail later, but the standard says that companies are required only to use all reasonable and supportable information available at the reporting date without undue cost and effort, and to use an approach that is commensurate with their circumstances, resources, and expertise for specific requirements. And we've talked a little bit already about the use of scenarios for conducting a resilience assessment. The thing to note is that IFRS S2 does require companies to use climate scenario analysis when assessing its resilience, but does not specify which particular scenarios the company is required to use. That is for management to decide. And finally, S2 does have requirements on strategic resilience. So things like it will ask for details on where there are significant areas of uncertainty considered by the company in its resilience assessment. What is the company's capacity to adjust and adapt its strategy and business model over time where resilience is threatened? And also details, of course, about how and when and what type of scenario analysis was carried out. We're going to move on to look at another specific part of S2 that differs from S1, and that is that where a company has a climate-related transition plan, S2 asks for companies to disclose detail about it. Now, just to clarify, S2 does not say that a company must have a transition plan. This is about disclosure of details of the plan if a company has one. So let's start with a definition of the transition plan. In S2, it is an aspect of the company's overall strategy that includes targets, actions, or resources for the transition towards a lower carbon economy, including, for example, greenhouse gas emissions reductions plans. So let's think about that in a bit more detail. First, because the transition plan is an aspect of the company's overall strategy, it should be aligned with that strategy, including the business case and motivation for the transition, and levers that the company's strategy is most suited to using, that are most economically and technologically feasible for decarbonisation or other aspects of the transition plan. Secondly, the transition plan should be aligned with certain external things, for example, the goals stated by science, what science says about requirements for net zero to be achieved, and how carbon neutrality or Paris-aligned goals are explained in terms of the science. Third, the plan should include long-term transition goals, but with clear mitigation and adaptation activities, but these need to be supported by interim targets and interim milestones. then we know that the way in which the climate transition will unfold is uncertain in terms of its timing and effect. But so that uncertainty should be recognized in transparency about the dependencies on which the company is dependent for the success of the plan, what risks and challenges it faces in executing the plan, how it will deal with residual or unabated greenhouse gas emissions, and so on. Then on the penultimate point, sector-specific pathways, while we know that the transition will proceed in different ways for different sectors, and therefore it's useful to look at sector-specific pathways to inform the development of the company's transition plan, we're going to look at some resources that might help with that in the next slide. And finally, there are organisations that are developing what they call the hallmarks of a credible transition plan. CDP, for example, has such hallmarks. And when developing the transition plan, companies should consider how their plan will be evaluated by investors and others, and whether the plan has the stated hallmarks of credibility. Let's have a look now at some of the resources that can help with transition plans and transition planning. Now, of course, we're only able to show you a few of them here. There are quite a lot of resources on transition plans. But let's start, and also the SSE itself has a training tool on transition plans, so have a look at that too. We shared the link to it earlier. But what you see on this slide, in the middle, we see some publications from the Glasgow Financial Alliance for Net Zero, GFANZ, and these set out expectations for the real economy and financial institutions on their transition plans. You can see that they've also published sectoral pathways for financial institutions, and these help companies understand how the transition could unfold for different sectors. On the right-hand side of the slide, you see the disclosure framework published by the Transition Plan Task Force. And this has been developed to support ISSB. And as we heard earlier, the disclosure aspects of the Transition Plan Task Force work have now been taken over by the ISSB. So this disclosure framework supports ISSB. And that's what you see on the left-hand side of the screen here. The little triangle or pyramid shows that the IFRS disclosure requirements on transition plans at the bottom of the triangle are supported by the work of GFANZ and by the Transition Pathway Task Force. All of that work is aligned and designed to help companies provide further depth and detail about their transition plans, and includes resources on how you actually go about developing your plan. So you'll be glad to hear that we're now going to take a short break, just 5 minutes. We have some nice music for you over the break. Have a good stretch and a drink perhaps, and keep giving us your questions. We're delighted to see them. We'll see you back here in 5 minutes. everybody. Welcome back. Hope you had a good break, a chance for a stretch and a drink. We're going to move on here to another core content area of standards, and this is about risk management. So as you can see from this high-level description, this category of disclosures requires report preparers to give information on their process for risk management for sustainability-related risks and opportunities, as well as how that process fits in to their overall risk profile. Let's have a look at that in a bit more detail. As a reminder, in the strategy content area, there's a requirement for companies to disclose information about their sustainability-related risks and opportunities. So there the focus is on what are the risks, what are the mitigations, the strategies and adaptations and so on, and how could they affect the company's prospects. This part of the content requirements really focuses on how the company identifies those risks and opportunities, how they identify, assess, prioritize and monitor them, as you see on the slide here, what processes and policies are used to do that, and how are they integrated into the company's overall risk management process. So a company is required to disclose information about these processes for risk management and opportunity management. So you might start to think internally about questions like, what are the inputs and parameters used for risk management? Are they suitable for identifying sustainability-related risks and opportunities? How do we prioritize these risks and opportunities? What are the criteria used to assess them? Is it probability, likelihood, magnitude of the risk? What are those criteria? What's the monitoring process and who does it? And whether and how processes have changed since the last reporting period. Beyond that, of course, as we've said, the standards ask whether the processes used to assess, monitor, identify, evaluate sustainability-related risks and opportunities are integrated into the company's overall enterprise risk management process. So having talked about the risk management disclosures in general terms, let's look at the climate-specific aspects of risk management disclosure. Now, again, this slide is entitled from TCFD to ISSB, but it tells us really what the IFRS S2 standard says about risk management. So it asks for detailed information about the input parameters used to identify risks, whether and how a climate-related scenario analysis is used to inform risk identification, and whether risk management processes have changed over time, in particular since the last reporting period. The same applies to opportunities, how processes are used to identify, prioritize and monitor them, and also how that's integrated into overall risk and other management processes. So let's have a look now at climate-related risks. So again, focusing on S2. And what we have here is a definition of climate-related risk, which you'll find in the appendix to S2. So here we see that the climate-related risks are separated into two categories. Transition risks arise from efforts to transition to a lower carbon economy and are often categorized as policy and legal, technological, market and reputational risks. Physical risks include risks from climate change that can be event-driven. These are acute physical risks that arise from weather-related events such as storms, floods, drought and heat waves, which we know are increasing in severity and frequency, or they can be chronic physical risks that arise from longer-term shifts in climatic patterns, including changes in rainfall and temperature, sea level rise, reduced water availability, changes in quality to water, biodiversity loss, and changes in productivity. So in the middle of this screen, we have some examples of the way in which these risks could manifest. So on the transition side, things like increased greenhouse gas emissions, pricing, more reporting obligations, exposure to litigation, and a changing consumer behaviour. And on the physical side, changing weather patterns, more extreme weather events. But in all of these cases, the risk can give rise to financial effects on the cash flows, access to finance for the company, its cost of capital, and these different financial effects can manifest over different timeframes, over the short, medium, and long term. Let's have a look at climate opportunities now. Climate-related opportunities refer to the potential positive effects arising from climate change for a company. So these could be things like efforts to mitigate or adapt to climate change that result in innovation to your operations, different product development, and the types of opportunities also we see listed on the left-hand side of the slide. You might become more resource efficient, change to lower emission sources of energy, develop new products and services for consumers who are looking for more sustainable products and services, enter into new markets for your products, and also increase the company's resilience. So we've got some examples in the middle that are quite similar to what I've just listed. So you might have supportive policy incentives in your jurisdiction that enable you to innovate more effectively, could use new technologies, as we've said, develop low emission goods and services, and have the opportunity to differentiate your company from your competitors and use different resources to perhaps you have used historically. And again, these opportunities have financial effects often. They can affect the company's cash flow, access to finance, and cost of capital over the short, medium, and long term. We're going to look at an example now, and this is an example from NATS, which is the UK air navigation service provider that handles UK domestic and North Atlantic air traffic control. So many of us know how bad weather, physical risks, causes delays for airlines, airports, and passengers, can also lead to increased CO2 emissions due to aircraft circling in holes or even being diverted as airspace becomes congested and inefficient. So I won't go into the example in a great deal of detail, except to say that in this example, the company has looked at how weather has increased risks in this year, 2019, in the first panel. So they've shown how much storms have cost, or an estimate of how much storms have cost, both in terms of money, but also in terms of extra fuel and CO2. The company also predicts or tries to forecast what these physical risks might mean in 2050, particularly in terms of the extra tons of CO2 per year that this might cost. So they're looking at some of the longer term patterns as well. And they're also looking at how there could be some opportunities here. The outcome of chronic changes might be positive in some respects, they say, on flight times and fuel burn, for example. So a little example showing how NATS has interpreted climate-related risks and opportunities. We're going to move now to the next core content with Bella.
Thanks, Lois. Okay. Oh, yes, we will now spend some time reviewing the disclosure requirements on metrics and targets in more detail, the final core content area of the standards. Let's start with metrics. Requirements on metrics are designed to enable investors to understand the company's performance in relation to its sustainability-related risks and opportunities. Preparers shall disclose information explaining how the metrics are defined, if they are absolute or relative, if they have been validated by a third party, as well as the methodology. And what is the method of calculation? What were the inputs? Are there limitations, and what assumptions are involved? And now let's move on to the second part of this category, targets. Requirements on targets are designed to enable investors to understand the targets a company has set to monitor progress towards achieving its strategic goals. Disclosures include whether they are qualitative or quantitative, and whether it is set voluntarily or by law or regulation. Of course, other disclosures include the metric used to set the target and to monitor progress towards its achievement, and also the baseline period from which progress is measured and the period to which the target applies. Also, what are the milestones and the interim targets? And if there have been any revisions to the target, together with an explanation about the revisions. So on the next slide, Lois will go through an example. Over to you, Lois.
Thanks, Bella. This example is from a company called ArcelorMittal. It's from their 2022 annual report. So bear in mind that some of the examples we're looking at were prepared before the ISSB standards were released, but they nevertheless show how certain things are already being done that are consistent with what the ISSB standards ask for. So ArcelorMittal is a multinational steel manufacturing and mining corporation, very big company. And this example is used to illustrate how the company is linking metrics and targets and their decarbonisation strategy. So the first thing to note is that the company's ambition is to have a leadership position within the steel industry and to achieve net zero steelmaking globally by 2050. We see that at the end of the first paragraph. So as the company has this decarbonisation commitment to achieve net zero steelmaking, what we can expect that there will be associated targets. And indeed, in the second paragraph, we see the company's target is to reduce carbon emissions intensity by 25% globally and 35% in Europe by 2030. So we can see different targets applied to different regions, and we have the timeline there to 2030. We also see the scope of the targets. So they tell us both targets cover scopes 1 and 2 greenhouse gas emissions for steel and mining per tonne of crude steel. The company set out its roadmap in 2021 for achieving these medium-term targets to 2030. So we know that that's elsewhere in their report. They also tell us what the anticipated gross investment is for these targets, and that's $10 billion US dollars. Elsewhere in this little extract, which we won't go into detail, what the company's telling us about is the dependencies for success of their plan. So what type of policy making and supportive framework they might need in order to deliver their plan. And they also tell us the assumptions behind their plan to deliver their ambition. So I think it's back to you now, Bella, for climate metrics and targets.
Thanks, Lois. Well, now let's talk about some of the climate-specific considerations for disclosures on metrics and targets. The TCFD framework included recommended disclosures, which IFRS S2 builds on, and S2 as part of required disclosures. For example, IFRS S2 requires disclosure of industry-based metrics relevant to a company's business model and activities. And also, additional disclosures are required on GHG emissions, including separate disclosures for the consolidated accounting group and the associated joint ventures, and the information about the company's financed emissions. In addition, S2 sets out a Scope 3 measurement framework to provide guidance for preparing Scope 3 GHG emissions disclosures. While S2 doesn't explicitly require a company to disaggregate its GHG emissions disclosures by the constituent gases, S1 includes requirements on disaggregation that would result in the disclosure of the constituent gases being required if such disaggregation provides material information. I'd like to remind everyone that you can access more information on climate metrics in the ISSB training tool on this topic. We will share the link in the chat, and you can also find it on the ISSB's website. Okay. Likewise, there are some additional disclosures compared to TCFD for targets as well. For example, IFRS S2 requires disclosures about how the latest international agreement on climate change has informed the target and whether the target has been validated by a third party. And also, IS2 also requires disclosure of more detailed information on GHG emissions targets, including additional information about any planned use of carbon credits to achieve a company's net GHG emissions targets. And IS2 also includes additional requirements to disclose information about the approach to setting and reviewing each target, and how it monitors progress against each target, including whether the target was derived using a sectorial decarbonization approach. Questions on GHG emissions often come up in questions on metrics and targets disclosures, so we wanted to address some of these briefly. For those who might not be familiar with the different scopes, well, there are three types of scope. Scope 1 includes all direct emissions that occur from sources owned or controlled by the company, such as emissions from your company's facilities or vehicles. And Scope 2 includes emissions from generation of acquired and consumed electricity, steam, heat, and cooling, such as the electricity you purchase. And finally, Scope 3 is all other indirect emissions that occur in the company's value chain. S2 requires a company to disclose its absolute gross Scope 1, 2, and 3 GHG emissions in accordance with the GHG Protocol corporate standard, unless a jurisdiction requires company to use a different approach to measurement. If a company is using a different measurement method, there is a transition relief to use that method in its first year of applying the standard. Whether and how the company is using an internal price on carbon for decision making. And also, S2 requires a company to disclose whether and how executive remuneration is linked to climate change. And then this slide, another example. Over to you, Lois.
Thank you, Bella. And this example is from Enel's 2022 Sustainability Report. And Enel is an Italian producer and distributor of electricity and gas, so a utilities company. And here's an example that shows the way or just one of the ways in which Enel disaggregates and explains its greenhouse gas emissions. And bear in mind, this is just an extract. So at the top of the page, you can see the company's carbon footprint broken down by the Scope 1, 2, and 3 greenhouse gas emissions Bella just explained. You can see that they also give a comparative analysis year on year. So the pale green bars represent the emissions in each of the scopes for 2021 and the darker green in 2022. So you can immediately see that really the majority of emissions come from Scope 3 sources and then next from Scope 1 sources, and they've given us the total GHG emissions as well. At the bottom of the page, what we're looking at is how Scope 1 greenhouse gas emissions are broken down between the company's business lines, between generation, trading, networks, end customers, and others. So you can see immediately from this breakdown that the majority of Scope 1 emissions come from generation, from thermal sources, so from the combustion of fuels in energy generation activities. You can also see that there are some little numbers just under the lines on that panel at the bottom, and those numbers refer to notes that you can see elsewhere in the report that explain these greenhouse gas emissions. So note 1 tells us that the majority of Scope 1 emissions were from carbon dioxide, but there were also emissions from methane and other sources. The little coloured dots that you see, they refer to whether and to what extent a greenhouse gas source is considered within a science-based target. So this little diagram tells us a lot about the amount of emissions, the type of emissions, the type of gas, the source, the trend over 2 years, and whether and to what extent emissions are considered within a science-based target for reductions. Let's go to another poll now about metrics and targets. So the poll asks for you to select all that you think apply here. What is the objective of metrics, the objective of the requirements to disclose information about metrics? Is it to enable users to understand the company's performance in relation to its sustainability-related risks and opportunities? Is it to understand progress towards any targets, or to understand the company's assumptions for the future? We really appreciate you participating in these Zoom polls. Brilliant participation here. So we are at well over 50% now, so I'm going to end the poll and share the results. And we'll see that most of you have answered A and B, and that is absolutely correct. Now, for those of you that answered C as well, yes, the metrics could help readers to understand the company's assumptions for the future. So it's not necessarily wrong, but the reason we've asked you the question in this way is to encourage you to really read the standards themselves. They're quite short, they're quite easy to read, but at the start of each of the content disclosure requirements, the standard sets out the objective. So paragraph 45 of IFRS S1 tells us that the objective of the disclosures on metrics and targets is to enable users of general purpose financial reports to understand the entity's performance in relation to sustainability related risks and opportunities and progress towards targets it set. So this is really a question about the exact wording of the standard to help us focus on that. And if we know the exact objective, it can really help to decide exactly what you're going to disclose. So always have a look at what the objective of the disclosure requirements is. So we're going to move on now to the next part of the Align module. And this is about the circumstances in which you might want to make disclosures in addition to those asked by the ISSB standards, and how you integrate those with ISSB disclosure requirements. So why might you want to disclose extra information? This is really because building on the baseline, you might have voluntary or mandatory requirements to conform with local requirements, could be listing requirements, could apply to both listed and non-listed companies and companies in your supply chain. You might want to make disclosures in addition to the global baseline because of policy objectives in the jurisdictions in which you operate. So governments might offer incentives like tax cuts or subsidies to encourage sustainable practices, or disincentives to discourage activities that are counter to national sustainability objectives. You might also want to provide additional information to align with emerging industry practices and guidance to effectively manage sustainability-related risks and opportunities within your sector. And companies might also want to disclose information for other stakeholders and their requirements, the types of information that they might have decided to disclose based on stakeholder engagement activities. So we also wanted to tell you about jurisdictional consultations that are going on. As you know, for the ISSB standards to be adopted, a jurisdiction has to decide to do that. And there are different ways in which jurisdictions do that. It might involve public consultation, setting up committees to look at the best way to adopt ISSB standards into the national regulatory context. So more than 20 jurisdictions have already decided to or are taking steps to introduce ISSB standards into their legal or regulatory frameworks. And together those jurisdictions account for about 55% of global GDP. There's more information about this and dedicated support from the IFRS as part of their regulatory implementation program. And we've given you a link there on the screen so that you can see the state of current and ongoing jurisdictions consultations around the world. So that's a record is kept of the current state. So do have a look at that if you're interested. So in addition, companies might want to make disclosures on top of the global baseline because they conform with other frameworks already, or because the ISSB is seeking to make its work interoperable, or that is to work together seamlessly with other types of work. So CDP, we've already said they've aligned their climate disclosure questionnaire to the ISSB's climate standard. The greenhouse gas protocol, as Bella said earlier, is the standard that must be used for measuring greenhouse gas emissions unless there are other regulatory requirements that override that. But to support this strategic interoperability, the ISSB is actively engaged in the GHG protocol team's governance arrangements and also in developing updates to the greenhouse gas protocol corporate standard. We're going to talk a little bit more in a moment about the work that ISSB is doing with GRI on interoperability. We've already said that the IFRS Foundation now has responsibility for disclosure-specific aspects of the Transition Plan Task Force work, and in their work plan from 2024 to 2026, the ISSB is researching disclosures on biodiversity, ecosystems and ecosystem services, and will be taking account of the work of the Task Force on Nature-related Financial Disclosures. So to the extent that additional disclosures are made, you can see that there are great efforts going on to make sure that the alignment is seamless. As I said earlier, we wanted to tell you a bit more about the work that ISSB and GRI are doing together. So they've committed to jointly identify and align common disclosures that address information needs under the distinct scopes and purposes of their respective standards for both thematic and sector-based standard setting. On the left-hand side of the screen, you can see a little picture of the document that GRI and ISSB produced on interoperability considerations for greenhouse gas emissions reporting. And this is an analysis and mapping showing how Scope 1, 2, and 3 emissions disclosure requirements are quite highly aligned across both GRI and IFRS S2. The public commitment to collaboration and to deliver full operability also applies to the work plan I've just described. So the ISSB's project on biodiversity, ecosystems and ecosystem services will take account of the GRI's work on biodiversity and their standard on that. And the IFRS Foundation is a convening partner of GRI's Sustainability Innovation Lab in Singapore. So lots of close work together between the two organisations there. Let's also talk for a moment about what's going on in Europe. So as you probably know, in Europe, there is the Corporate Sustainability Reporting Directive that requires companies to make disclosure reporting. And the standards for that law are European sustainability reporting standards set by a body called IFRS. Now, the two organisations, the Europe and the IFRS Foundation, are working closely together again to ensure alignment between their respective standards. There's already been work done on the interoperability of climate-related disclosures, and that work has found that there is a high degree of alignment between the disclosures, and you can see that there's a link to joint guidance that has been produced. That's at the bottom of the slide there. So more activity to really seek to reduce complexity and duplication for companies that have to or choose to apply both the European standards and the ISSB standards. Just a quick word now on integrated reporting. As you know, the integrated reporting framework provides principles-based guidance for reporting structure and content. Again, there's a high degree of alignment, especially with the architecture with IFRS S1 and S2. So when used together, these are complementary tools that can give readers a more holistic view of a company's value creation process and a more complete picture of how value is created over time. Again, we see on the left-hand side the front cover of a document, a getting started guide to transitioning to integrated reporting and using integrated reporting to support ISSB standards. So there are tools that are accessed from this document, including dedicated frequently asked questions, a mapping tool, and this getting started guide. Perhaps the most important thing to say about integrated reporting, though, is that it's supported by integrated thinking, which enhances coherence, connectivity, the quality of governance, and overall thinking about how to prepare and present sustainability disclosures. So we're going to end with Zoom poll 8. We've looked at lots of different things that are interoperable with the ISSB standards, can be taken into account. So you can only choose one answer here, but when you're thinking about the company's disclosure objectives, should you consider the ISSB standards only, the ISSB standards and regulatory requirements, just regulatory requirements, or all of the above and other sources of guidance? Yes, lots of participation. Thank you so much for this, and a very clear pattern has emerged. So I will end the poll and share the results, and we'll see, yes, the majority of you said all of these can apply when you're thinking about your disclosure objectives. So there's plenty of support and guidance and variety to enable companies to satisfy their own disclosure objectives and the standards, of course, and regulation. So let's hand over to Fiona for a summary of Module 2.
Great, thanks so much, Lois, and so great to have so many of you participating in the polls as well. Brilliant. So as Lois has mentioned, we're now coming up to the end of Module 2, and as I've shared in the chat, we'll be going back into Menti shortly, and I see lots of you are already there, so that's fantastic. But before we look at that exercise, we just wanted to take a minute to remind ourselves on what we've learned in this module. So we reviewed all 4 core content areas of the ISSB standards. So that's governance, strategy, risk management, and metrics and targets. But it's an important thing to remember here that these don't operate in silos. We saw in the examples from company reports that despite having 4 separate content categories, they're all interconnected. We also discussed how your disclosure might go beyond the requirements of S1 and S2. So for example, to meet different stakeholder needs, to meet regulatory requirements in certain jurisdictions, or of course to meet industry standards as well. And of course, we know that regulatory requirements are a big focus for you all at present, understandably. So what's important to remember when you're doing this is that the ISSB standards have been purposefully developed to act as a baseline. And the building blocks approach allows reporters to add additional disclosures on top. But in doing so, we would just remind you as well that you need to be careful not to obscure the requirements of S1 and 2. So make sure to keep that focus on concise material information to the extent that you can where possible. Okay, so as I said, we're going to head back to Menti to get you thinking again and applying some of those thoughts into action. So our next exercise is asking you around the tools that you can use to identify gaps in your current disclosure. So we talked already about conducting a gap analysis and that being important, and thinking about what the enhancements are that you need to make. But what we're just wanting you to think about here are actually what are the practical tools that you're going to draw upon to help you in that gap analysis. That might be certain resource, certain particular guidance or other types of tools. So we'd love to get your thoughts on this one. So I will share the Menti screen again so that you can see the answers coming through. I should say as well that the QR code is visible there at the top of the screen for you again, so that you can see that code and use it if you need to access that. So I'll just leave that on the screen for a little time in case anyone needs that to access the results. So we've had lots of responses in already, which is fantastic. I see we've had the ISSB highlighted. So yeah, of course, referring to the standards themselves is very valuable to conduct that gap analysis. Lots of references to using the GRI as well. Of course, the Bursa Sustainability Disclosure Toolkit is exactly a fantastic place to go as you're looking to make sure that you're tailored to meeting the Bursa's requirements. Sustainability Reporting Guide and Toolkits, which I believe is the same resource, so that's fantastic. The IFRS Framework, indeed. Statistical Analysis, or the TCFD. Looking to ChatGPT, quite possibly, might be able to give you a summary of some of the key things to consider. Hiring a consultant may indeed be a valuable way to go to get some extra resource and insights. Yeah, let's keep scrolling along. Thank you so much for all of the engagement. Thanks again for highlighting the SSE's tools here again. So yeah, as we've shared, we do hope that those are valuable for you and act as a bit of a checklist to help you work through a gap analysis. Peer reports, yes, exactly. So, you know, if you're aware of leading competitors in your industry, referring to their reporting can absolutely be valuable. And I know we've had some questions about where to find examples. There are several knowledge hubs that we'll refer to at the end of the presentation, which can perhaps help you with finding those examples. But we'd encourage you, I guess, just to make a list of who your competitors are that you might see applying in your sector more broadly, and to make sure that you're, you know, just going and finding their reports, having a read, seeing what you think is good about it, and sharing that with your colleagues. You're unlikely to find a perfect report out there that, you know, comprehensively answers everything, but looking and pulling out the excerpts and approaches that you like from others that you can reflect for you can be really helpful. Okay, lots of great thoughts again. Yep, you know, going back to the TCFD, as we've already said, using your own risk registers, perhaps a good idea, you know, to look at, you know, maybe there are risks already in there that you're not reporting on publicly at the moment, or maybe you could do more to report on what you're doing to manage those risks. So that might be a good source of inspiration. Great. We've seen some mentions of the SBTI, and that's with specific reference to climate targets as well. So that may be helpful. the IFRS PACE aspect as well, which Dr. Hertzi mentioned earlier. So I think, of course, making sure to reference that and consider what it can do to support you is brilliant. Okay. Lots of great ideas. I'm seeing some commonality, so I'll just do a quick scroll and see if anything jumps out at me that we've not already mentioned. I think we've got some good commonality in what we want to do here, so that's excellent. So I think we've probably highlighted everything that we would recommend there. But of course, just making sure to go back to S1 and S2 and look at the guidance associated with each standard and to use those mapping documents as we talked about previously in Lois's segment of mapping between the prior voluntary frameworks and the ISSB standards can be really helpful because as we saw at the start, a lot of you are using those frameworks already. So hopefully that mapping can then help you to see what steps you need to take to go from those voluntary frameworks to the ISSB standards. Excellent. So that's great. So I will just take us back into the presentation now so we can carry on to the next segment. So I'll be handing back over to Lois to that. So thanks, Lois.
Lovely. Well, we're now on to module 3, the backbone of effective disclosure. This is more about processes and practices. So the ISSB standards really set out what a company should disclose, the disclosure requirements. But and of course, because they're focused on what a company should disclose, there's limited information in the standards about how those disclosures should be prepared and what sorts of practices and processes apply. But we can see from your contributions to Menti that you'll probably have lots of relevant processes and practices that can be used already. So in this module we call Implement, we've got 3 different sections, and we're going to start with Identify. And this really is about the identification of sustainability related risks and opportunities. So within the standard, the ISSB says that companies should provide material information on all sustainability related risks and opportunities that could reasonably be expected to affect the company's prospects. And IFRS S2 has similar requirements for climate related disclosures, as we've seen. So first of all, how do you identify the risks and opportunities, and what if you've identified risks and opportunities beyond those applicable to climate change? So could be water, human rights, biodiversity, nature, and so on. So the standard says that when identifying which risks and opportunities to disclose, a company must consider the ISSB standards. As some of you probably know, the ISSB standards are industry-based, so they set out what disclosure topics and associated metrics might be relevant in terms of risks and opportunities for particular industries. A company may also refer to the CDSB framework application guidance available from the IFRS website, and that has guidance on climate, nature, biodiversity, water, and social matters. Companies can also consider industry practices, so you might belong to a sector group that sets out guidance for your industry, or the materials of investor-focused standard setters, as we saw on a screen much earlier, where we saw the logos of organizations creating frameworks and tools designed to satisfy the investor information needs. So having decided which risks and opportunities apply to your business, which will also be informed by your risk management process, of course, then the decision is what information to disclose. Well as the ISSB standards, companies must consider the ISSB standards for this. Again, they set out the disclosure topics and associated metrics for particular industries. Companies may also consider the CDSB framework, industry practice and investor-focused materials, as we've already referred to, but also for this purpose, when determining which information to disclose about the risks and opportunities, companies may consider the GRI standards and the European Sustainability Reporting Standards. So we're just going to have a look now at an example of how a company called Yara has gone about identifying its risks and opportunities. Now, bear in mind that this is from their 2022 company report. So this was prepared before the ISSB standards were issued and before we had the guidance that I just explained on the last slide. So Yara is an international crop nutrition company, and at the top of the slide we see that they start to think about their risks and opportunities from a global macro and megatrend point of view. So they outline what they see as the megatrends that then could have a kind of cascade effect on their business. So really the important thing is at the bottom of the screen, they set out the way in which those megatrends could manifest in terms of risks and opportunities for their own business. So on the risk side, they point to regulatory changes, consumer demand for sustainability, and optimized fertilizer use. Now, that optimized fertilizer use could lead to lower fertilizer demand growth, so they see that as a risk to them. Of course, as a global crop nutrition company, they also identify risks from physical climate change risks to their operations and customers, perhaps increased environmental costs and taxes, and the physical changes to their affecting their operations also present risks. On the opportunity side, they say that the shift towards sustainability actually might be an opportunity in terms of the way in which fertilizers are used more effectively for the development of their products. They say that they can use digital tools to enable new market channels and reduce the yield gap through farmer connectivity. So here the digital tools include things like drones that can be used for connecting farmers and observing crops. The focus on soil health and water use is something that this company can contribute to, so as an opportunity for them. So in this example, what we see is the risk identification coming from the macro trends and being translated into particular trends for the company. Let's look at another example now with a different approach, and this is an extract from Nest's 2023 annual report. So Nest is a company based in Finland, and it's a leading producer of sustainable aviation fuel, renewable diesel and feedstocks for the chemical industry. So it wants to use science and technology to transform waste and other resources into renewable fuels and circular raw materials, and also help their customers to reduce their handprint, if you like, as well. So this extract comes from the climate section of the company's annual report, and it shows how the company has identified risks and opportunities informed by 3 different temperature scenarios. The net zero world, broadly equivalent to a 1.5 temperature scenario, and the compromised climate targets, a 2.5 to 3 degree scenario. The extract shows the overall assessment of the risks and opportunities and whether and to what extent they are positive or otherwise for the company in these 3 different scenarios. Right on the bottom line, we see that they also give us an indicative financial impact on the company, and the most positive impact is in the net zero world or 1.5 temperature outcome scenario, and perhaps that's to be expected because the company is focused on producing more sustainable products. But what we see is that the way that they assess their risks is different in different scenarios, as you would expect. Now, of course, the ISSB recognises that the risk identification, deciding what to report, how to get the information, how to report it, is challenging. It's quite a new aspect of reporting. It's challenging, but it's very valuable because it helps companies to understand their own risk and opportunity landscape. But to make sure that the effort involved is proportional to the benefit, the ISSB standards specify that in applying specific requirements, including on risks and opportunities, companies are only required to use all information available at the reporting date without undue cost or effort. What is reasonable and supportable information then? Well, it's information that's specific to the company. We saw that Yara did that in their example. They made the risks and opportunities very specific to their activities. It takes account of the external environment, so perhaps the views of stakeholders or perhaps mega trends. It includes information about past events and current conditions that companies will already know about, but also their forecasts, perhaps informed by scenarios. And in some cases, the type of information to be disclosed is specified in the ISSB disclosure standards. And don't forget, as we said earlier, that there is also the proportionality mechanism that the standards allow preparers to use information that is commensurate with their skills, capabilities, and resources when applying certain of the requirements. So Fiona, you're going to take us through the next part of the implement module.
Indeed, thanks, Lois. Brilliant. So once risks and opportunities have been identified, companies are then going to need to evaluate the financial effect of those risks and opportunities. And this can, of course, be quite a daunting task when you're first getting started. So here we're going to briefly review a few key concepts to hopefully help you in doing so. So to help investors understand a company's resilience against climate risk, S2 requires you to disclose information about the implications of climate change on your strategy and business model. It also asks companies for their financial and operational capacity to adjust or adapt over the short, medium, and long term. So, for example, you might test your company's resilience against new regulation to limit high emissions activities, or your company's ability to respond to changing crop yields due to more frequent heat waves. So to do this, you'll need to use scenarios based on science and analyze how these scenarios will lead to the company's incurring effects. And it's important to remember that scenario analysis is not considered a prediction or forecast of the future. It's around projecting plausible future potentials. So just to consider those possibilities of what may occur and help you to build a strategy that's resilient to multiple possible pathways. So S2 doesn't specify which scenarios a company should use in its analysis, as it leaves that down to the company to determine based on its risks that it wishes to consider, and indeed the nature of its operations and industry. So the sources that you might draw upon here will vary depending on your location, perhaps whether you're looking at transition risks or physical risk, and what sector you're in. However, S2 asks you to make sure that you're using relevant scenarios and to provide information about how you've decided which scenarios to select. It then asks you to consider the assumptions that you have made in those scenarios and to report those. The S2 standard then includes guidance on how a company can determine its approach to scenario analysis. And this encompasses a real range of practices from simple qualitative scenario and narratives to moving towards more complex statistical and quantitative modeling over time. And in progressing the maturity of your scenario analysis, it's important to take a materiality focus here. So focusing greater levels of quantitative analysis on areas where you've identified anticipated potential material financial effects and zoning in on those. So overall, considering this, the ISSB standards ask companies to use an approach that's commensurate with their circumstances and to use all reasonable and supportable information that's available to them at the reporting date without undue cost or effort. So let's now use an example to zone in on that a little bit and see how one organization is approaching this. So here we have Cemex, which is a Mexican multinational building materials company, and they're active in over 50 different countries globally. So CEMEX has used a climate scenario analysis in its integrated report, and it illustrates how it combines this analysis with its own achievement of its climate targets as well. So within the table that you see here, they've disclosed on the left-hand side, the two key areas of risks and opportunities and the individual risks and opportunities that they face in the business. What they've then done is assessed each of these risks and opportunities under 3 different climate scenarios. So stated policies, sustainable development, and net zero emissions. And those all draw from the work of the IEA, or International Energy Agency. So under those 3 scenarios, they've disclosed what they expect the probability and impact of those risk opportunities to be. So you'll see that they've then assessed that actually that can vary under each scenario. And in particular, perhaps some of the opportunities are higher for them under a net zero emissions trajectory. So they also, in another part of the integrated report that you can refer to, include some information outlining a summary of what each of these scenarios is, what the source was, what temperature range they'll expect to see under each scenario, and the main assumptions. So I think that's an important reminder of a key concept here, which is to make sure that when you're disclosing the results of scenario analysis to your investors, you're also explaining how you've arrived at those results. And it's also really important here to think about how you're connecting your own commitments, policies, and strategic goals to this scenario assessment. So how are you demonstrating that you've integrated that consideration? Apologies, wrong direction. There we go. So then, thinking about anticipating. Sorry, I think we have a slight delay. There we go. So anticipating the materiality of future events can also be a bit challenging. So to help with this determination, IFRS S1 asks you to consider a number of issues to help you with this determination. So you could think of this list as identifying all the steps and information you need to come to your judgment. So for example, companies should be considering all low probability and high impact events. And any uncertainty relating to the company's future cash flows should also be evaluated. Another important point here is the need to reassess this at each reporting period. So whilst it's perfectly understood that there will be uncertainties here, it's important that you constantly keep that information under review and you're transparent about disclosing where judgments have been made and where you may have uncertainties in your assessment. Okay, back to you, Lewis.
Thank you, Fiona. Sorry for the delay while I've been very fascinated in all the questions that are coming through. So we're going to turn now to the next part of our implement module, which is integrate. Now, as we've seen from the Menti, many of you have talked about gap analyses and some of the things that you're already doing. So when you're thinking about the processes that might be required to support sustainability disclosure, many of them may already be within your organization. So you may not be starting from scratch. You may actually be thinking about how you can use your existing processes or adapt them for sustainability disclosure. So what sorts of things might you want to think about when considering whether to create or adjust a process you already have? Well, we've already talked about gap analysis. That came up a lot on the Mentees, just to check what the existing systems and processes consider. Then how suitable are those existing processes for identifying sustainability-related risks and opportunities? As we know, they can manifest over longer time frames and be a lot more uncertain. So are different criteria needed to be added to your processes to take account of those uncertainties and different time frames? So in addition to probability, likelihood, perhaps adding criteria such as impact, vulnerability, and speed of onset. Similarly, are the existing internal risk controls frameworks suitable for sustainability-related disclosure and risk and opportunity identification? Then we move on to considering, well, who in the organisation might contribute towards the sustainability disclosure? Which departments would be involved? I think we saw again, you mentioned these on the Menti. Would it be HR, finance, the procurement department, the risk management department, company secretarial, the board, executive management? Who needs to be involved? And in particular, at the operational level, who has processes and expertise that can contribute towards collecting the information and ensuring its quality? What are the interconnections between different internal and external factors that you might take into consideration? Something like perhaps how would peer practice influence the way in which you carry out your own processes? We've talked again about the uncertainties associated with sustainability-related risks and opportunities, but when considering what process you might need, what is the process for identifying and managing and responding to the uncertainty? Will there be a continuous improvement program, for example, to uncover some of the more tricky aspects of those uncertainties? And finally, of course, you'll need to think about what resources you need to manage existing or develop new systems and processes. So might you need to go through a change management process internally or seek new budget for these resources? Now, in your homework, we have suggested, it's not mandatory, but we suggest the homework could be to develop a disclosure plan that thinks about some of these things. So a disclosure plan can be a standalone strategy or part of a wider disclosure strategy that takes account of all of the types of, or some of the types of reporting that you have to do, as well as sustainability disclosure. So a disclosure plan might record the company's reporting goals and objectives. So it might record what you have to comply with in terms of laws and standards and what you would like to communicate in terms of management strategies. How those different goals and requirements will be managed and what audiences you want to communicate with. Is it just investors? Is it wider stakeholders? And how have those audiences been identified? As we just talked about, you can record in a disclosure plan who will be involved in developing disclosures from within your organization or perhaps from an internal consultancy. So you have a record of who's involved, what their responsibilities are, and how their responsibilities will be organized according to timelines and outputs. How are you going to collect data? Where will you source it from? Can you use existing systems and controls? How will you ensure the quality of that data? What will be the process? What about assurance? Will some or all of the disclosures be assured externally or internally? By whom? According to what standard? And finally, and most importantly, I think, what will be the sign-off processes and procedures? Who will do that? So in summary, we think that a disclosure plan, by creating one, you can take control of the company's narrative. After all, the standards ask you about your risks as a company, your strategies, etc. It can support the internal collaboration and knowledge sharing that we've talked about by recording who does what, why, and how, and according to what processes. But in my opinion, the most important one here is it creates a reference point and audit trail, including about where and how judgments have been made. So when you start or end a reporting here, you know where you stand, you have that position. Now we'll have a quick look at just one example from Hammerson about the sorts of things they do. It's not exactly about their disclosure plan, but it is about elements of what you would expect to see in a disclosure plan. So Hammerson is a British property developer, and what we see in this report is that they set out the basis of reporting. So they're setting out how they have done their reporting on environmental and social impacts of their business activities. We see the reporting period for the information. We can see where they have put information, whether it's been verified, the approach and scope used for data collection, and there's other contextual information that's really there to help the reader better understand how things have been done. And as we said before, agreeing this before you start data collection will be more helpful than trying to do this exercise in retrospect. But you can also see in this example which types of standards, voluntary non-financial disclosure standards, Hammerson used and where their GRI index is. You get a little navigation to that. So let's look at a Zoom poll about disclosure plans. And you can only select one answer here. So the question is a disclosure plan required by IFRS sustainability disclosure standards? And the possible answers are yes, you must disclose your plan, or no, but it's a very helpful tool. Always like to give people a bit of time to think about this one. Yes, we're over 50% participation. So I'm going to end the poll there and share the results. And you'll see that 60% of you said, no, a disclosure plan is not required, but it's a very helpful tool. And those of you that said no, you are correct. There is nothing in the IFRS sustainability disclosure standards that says you must have a disclosure plan and you must disclose details of it. The standards do say in certain places you must disclose which methodology you've used for certain calculations, you must disclose what process, what your approach was. Yes, there are parts of the disclosure requirements that ask you to explain how you've done things, but there is no requirement for an overall disclosure plan. We're just suggesting it because we think it's a helpful tool for your homework, although nothing mandatory about it. So we'll just quickly zoom through the next Zoom poll to make sure we keep on time. I'm guessing you'll all know the answers to this. A disclosure plan can help a company too. You can select as many as you think apply, take control of its narrative, support collaboration, act as a reference point, or skip full disclosure as prescribed by the ISSB. Just giving you a moment here to think about this, but I can see that you know the answer. So I'm going to end the poll and share the results. Of course, you're right. It's A, B, and C, the first three that apply. Having a disclosure plan is not an excuse to skip full disclosure as prescribed by the ISSB. So well done. You understand that well. It's not mandatory, but it's helpful in the ways that you have identified. So it's over to Fiona now for a summary of Module 3.
Thanks, Lois. And as you're probably guessing, if you're seeing me again, that means we're on to a summary. So a few recaps from this segment. Connections really is something that obviously we've set out as being key here. And in the last module, we wrapped up highlighting the importance of connections between those 4 core disclosure content areas. And then we learned in this module that there are many connections as well between a company and its external and internal environment. And this is what we really need to focus on when we're assessing risks and opportunity. The second thing we talked about was related to evaluating those risks and opportunities. And a key component of that evaluation is consistency in your assumptions. So using scenario analysis, as we've talked about, is a helpful tool, but it's important to be clear on any assumptions you're employing. And finally, as we've seen, even if some of this data isn't data that you're already disclosing, you may well already be collecting some of it for different reasons internally or operationally. Or perhaps you have existing processes that you could adapt to allow you to collect new information that just need small adjustments. So as much as you can, we'd recommend trying not to start from scratch with this and to make sure you're using what you already have to support you in this process. Okay, so that brings us round to our final Menti activity, which we'll probably do a little quickly, but we'll just take a couple of minutes on this. So here we're looking to think about those gaps that we've identified, in particular with respect to data collection and metrics. So here we want to think about how we can adapt our existing systems and processes to support sustainability-related metric data collection. So just take a second, have a little think in Menti and share with us what you think some of the relevant approaches might be to support you on the data front. Okay, so lots of responses already in, so thanks for being so attentive to the mentees, that's great. So we've got the Synergy Sustainability module, which sounds like a particular tool which is useful. The CSI platform, you may start with Excels, yes, exactly, or existing systems. So never a bad place to start as you get an initial understanding and then work out what systems you actually need to support you in collecting the data in the right format moving forwards. ESG dashboards. Yeah, I think particularly when you're working with senior management, setting up dashboards so they can see a high level overview on things is great. Using your existing financial disclosures, exactly. You know, a lot of this information is very much connected to that and should be. So making sure you're drawing on what is already in place there. Customizing data templates using Excel, incorporating the pillars of different frameworks, using the company's ERP system. Yes, exactly. So those systems would already be set up in a robust way to support financial reporting with the right forms of control, auditor access, etc. So utilizing those systems, if you can, is great. Or indeed, you know, there are many ESG specific software platforms as well that are now coming forward with those sorts of requirements as we're moving towards mandatory standards and regulation. Data templates to be filled in by data owners. Yes, exactly. So tailoring that to what you need from different parts of the business, making sure you're helping people to understand what you need, why you need it, you know, the importance of robustness and consistency as well. Okay, oh, yeah, I thought I would have some more responses popping up, and here we are. So Google Forms, Excel, interviews and surveys. Yes, exactly. You know, I think particularly when you're looking at material topics, starting by just interviewing and surveying can be a very good starting point to drive greater data collection and making sure that you're aware of what's going on in the business already in terms of data reporting. Using compliance processes, ISO standards, financial systems, templates, SharePoint, online survey accounting. Excellent. Oh yes, lots more. So loads of really good ideas here. So I'll keep it scrolling along a little bit so you can just have a little flick through and see some of those ideas. I think you've probably highlighted a lot of what we would recommend there, but probably just the only thing that we would draw out additionally as a reminder is making sure to look at your enterprise risk management process. So particularly looking at the risks and opportunities that you're already reporting, but also drawing from the toolkit within your ERM process to support you in identifying, assessing and managing sustainability related risks. And maybe just the final thing as well is just to remember governance when you're setting up your data collection as well. So thinking about what the governance requirements will be to ensure that you have robust data collection in place. So thanks everyone again for sharing all of your great ideas. And I'll hand you over to Robert now for the next module.
Yes, perfect, Fiona. Thank you very much, and hello everyone. Indeed, we're now moving to the last module of this session, module 4 about communicating. We'll be discussing on what and where and how, so a bit of a practical information you might be asking yourself when disclosing your sustainability information. So perfect. We'll be looking at three units within this module about the location and timing of your sustainability information, how to make sure you put through your disclosures in an efficient manner, and we're talking at the end about confidence. All right, we will start with the location of the disclosures and where they should appear. But before we will talk into details, I want to tell you something about this dual reporting package you might want to consider when thinking about, on one hand, investor-focused information developed by the IFRS, and on the other hand, complementing in the multi-stakeholder focused information, which then GR standards will be helpful. So on the left side, then you would then see that the investors already have access to a company's financial statements, and ISB standards are designed to identify sustainability-related risks and opportunities that complement the financial statements. These all come together in a reporting package that we call a general purpose financial report. And the requirements in the ISSB standards about what information to report are based on existing sustainability regimes, focus on investor information needs, and on aspects of financial standards. So what is important to note here that ISSB and GRI reporting standards share same content requirements, for example, what to report, but the ISB standards are focused only on investors' information needs and decision-making, reflecting the mission of the IFRS Foundation, which is to bring the transparency, accountability, and efficiency to capital markets around the world. So both organizations, IFRS and GRI, take different approaches to defining materiality, but they are not competing. So the GRI approach is set out and understood among sustainability practitioners, whereas the IFRS approach is familiar to accountants and relies heavily on management judgment, aligning with existing corporate risk management processes. So it could be a simple example is where a double materiality assessment identifies that some of the company's impacts may also create sustainability risks, which could be so significant that they are important to disclose to investors. So there might be overlap between the two. All right. And on the next slide, we'll be talking shortly again about the definition of the materiality and what is that understood in the context of IFRS. So as we just noted, materiality has different definitions for different reporting standards and audiences. So let's briefly recap what we mean by material information for the IFRS. In identifying material information to be disclosed, a company will first need to identify the sustainability-related risks and opportunities that could reasonably be expected to affect its prospects. Once the company has identified those risks and opportunities, it can then determine what information to provide about those risks and opportunities. This is where our materiality definition comes into play. So the definition of material information used is based on and aligned with definition found in the IFRS accounting standards. So this is the information. So material information is the information that, if omitted, misstated, or obscured by other information, could reasonably be expected to influence investor decisions. In other words, the ISSB standards seek to identify the disclosure of key information that matters to investors. All right, and I'll be going to the a poll. And so just to recap what we've been talking about. So the question here is that, well, if information should be disclosed in the annual report when applying ISSB standards, and we have three options in there, we can use select multiple. The first one is A, omitting that information could reasonably be expected to influence investors' decision. B, it could reasonably be expected to affect the company's cash flows. And C, it exemplifies the values of the leadership team. So the poll should be now open for voting. For some reasons, I don't see the answers coming in.
Sorry about that, Robert. I'll just see if I can address that for you.
Thank you.
We're over 50%, Robert.
Okay, good. I don't know which. Oh, perfect. Now I see the results. Very well. Yes, most of you answered correctly. So the correct answers are A and B. So these are the factors of the qualities of the material information. It should not be it's not about exemplifying the values of the leadership team. So the answer C is incorrect. So congratulations to those who answered A and B, which are the correct answers. Thank you. All right, and now we're moving to the next section, where to report the for ISSB. So disclosure under the ISSB standards has to accompany the financial statements and be part of the same general purpose financial reporting package. But S1 does not say where in the reporting package the information shall be provided. This is designed to allow jurisdiction-specific requirements on the location of the reporting. The most important factor, though, is to consider to ensure that sustainability disclosures are provided as a part of the same reporting package as the company financial statements. Sustainability disclosure must be provided also at the same time as the related financial statements, cover the same reporting period as the financial statements, and be authorized by the same body or individual authorizing the financial statements. What we noted, or the research made by the WBCSD on the state of integrated reporting shows that nearly 2/3 of companies continue to put sustainability information in standalone report. And this is not what ISB standards require. The ISB standards require material information related financial disclosures to be included with the general purpose financial reports. So this suggests companies have some way to get to their internal processes and disclosures applying a lot. And to talk how this may work in practice, we will have an example here. Over to you, Lois.
Thank you. Yes, as Robert has said, there are many different ways in which a company can present information or might be required to present information, but ISSB standards say that sustainability information should be in the same reporting package as the financial statements. Now, this is an example from a company called Ayala, which is a Philippines-based conglomerate. So they have lots of different diversified business activities, banks, healthcare, technology, etc. And this particular depiction is an integrated report. So it's based on the integrated report, sometimes fondly called octopus model, that shows the incoming capitals to the value creation model, financial, intellectual, human, social and relationship capital, the value creation model in the middle with information about it, and then the value generated in terms of different capitals as the outcome. Now, this diagram has been used to summarize what's in the integrated report, and the arrows show the navigation that they provide to where different types of information is provided. So we can see strategy on page 50, for example, Outlook, also from that page. So it shows how sustainability related information is located alongside other information in the same category. It gives you this comprehensive picture of how the company treats sustainability information in relation to other matters in this one snapshot of their reporting. Of course, this and other examples assume that we've got PDF reporting that we can, we take these snips from PDFs, but digital reporting is developing fast, and that's what Robert's going to tell us about next.
Yes, indeed. Thank you very much, Lois. As Lois mentioned, technology is an emerging consideration for disclosures, and increasingly corporate reporting is moving from PDF reports towards information on web pages with structured data sets, such as those databases offered by stock exchanges. The IFRS Foundation has created the ISSB taxonomy, which reflects the requirements and accompanying materials for the ISSB standards. So the taxonomy does not introduce a new requirement. A digital taxonomy provides, though, the common elements, so-called tags, needed to make your sustainability disclosures machine readable. This means it's easier to take large data sets, like information from entire industry, and bring them all together to analyze them. So digital reporting has a number of benefits and makes the reported information easier to use for analysis that are structured the same across different businesses in a machine-readable format. Tagging information potentially also allows for automated checks for quality and consistency. More and more data collection management systems are compatible with digital reporting taxonomies, improving processing and report preparation. And text can have labels and descriptions in multiple languages. So if you report your quantitative data in one language, someone speaking another language can also understand what it means. Right, and we'll be moving then to the next unit with this module about communication. We had some questions on the Q&A about this one, so I'm happy then to discuss this into more detail. So yeah, following the discussion on location and timing, let's now think about ensuring efficient disclosures. We added this to the training because a common comment we find from companies is that there is a growing reporting burden. And what we hope to highlight is that when done correctly, efficiencies can be made to reduce that burden. So first of all, it's important to understand what effective communication looks like and what is required. Often companies think that if they just put all the information they have into a report, then everyone will be satisfied. However, this would be against the core concepts, in particular fair presentation. For example, it could be helpful to ask following questions. Is the information clear and concise? And what clear we mean that that might depend on the nature of the information. For example, whether it could be clearer to present information in tables, graphs, diagrams, plus accompanying text. And concise, to be concise, disclosures need to avoid boilerplate information, unnecessary duplication of information, and to use clear language. And regarding the quality information disclosed, some preparers watching today might be thinking to themselves that they still don't see what is all the fuss about. Perhaps their experience focuses on standalone sustainability reports, or they haven't had much interaction with the external audit. So to all the accountants watching, I say be kind to your colleagues, help them understand the difference in rigor required in data collection, oversight, sign-off, etc. for financial statements. So this means, for example, disclosures include comparative information and are to be restated as necessary. Disclosures should avoid unnecessary duplication and use cross-reference as required. Information has to be material, be connected, aggregated, or disaggregated appropriately. And with the next slide, we'll be talking a little bit more about cross-referencing. So as you may have already noticed, there may appear to be some overlap in the disclosures topics. For example, you might have the same governance approach for all sustainability issues. And rather than to duplicate certain information, you can use cross-referencing to enhance efficiency of your disclosures. So cross-referencing to other reports is permitted as long as the other report is available on the same terms and at the same time as the sustainability disclosures. The cross-reference information is assumed to become a part of the reporting package. Cross-referencing shall be applied consistently and transparently. It should not result in information becoming more difficult to understand. And to better understand it and reflect how it can be done in practice, we have an example here. Over to you, Louise.
Thanks, Robert. Yes, and this example is from, sorry, I'll just move ahead. Beg your pardon. Yes, this example is from the 2022 annual report of a company called CRH, which is an Irish company that supplies products to the construction industry. And this is an example of cross-referencing, and bear in mind it was prepared before the ISSB standards were produced. It's an example about how carbon emission reductions targets and climate risks are connected with and cross-referenced to the financial statements. Now, at the moment, there is a consultation out from the International Accounting Standards Board on climate-related risks in the financial statements that's very relevant to what we're discussing here. And I've just put a link to that consultation in the chat. Briefly, with this example, what we see at the top of the page is the company describing the risks identified in their TCFD disclosures and also the impact of achieving the group's carbon emission reductions targets. They're really thinking about whether those two things have a material impact on the estimates and assumptions made in the preparation of the group's consolidated financial statements. In the middle of the slide, what you see is they're telling us exactly which line items they have considered when thinking about whether there is an effect of these risks, opportunities, and emissions reduction targets on these particular line items. Impairment testing of goodwill, useful lives of assets, provisions for liabilities, and so on. They cross-reference to the pages where you see those line items. So we know that they have drawn that link, they cross-refer from their risks and opportunities on pages 56 and 59 to the pages where the line items are that they've considered the effect on in the financial statements. Now, what they conclude is that there is no material impact on the financial statements as a result of the climate risks and the emissions reductions targets. They've used the company's accounting policies, estimates, and underlying assumptions to make that judgment. There's no material impacts. Now, one might say, well, why have they made a disclosure when there's no material impact? But this is very, very useful additional information because the reader might assume that if there are risks and if there is an emissions reduction plan, there might be some effect on the financial statement. So they're reassuring the reader, yes, we've considered it, there is no effect, and that's useful information, and you'll see more about that if you look at the examples in the ISSB consultation. So hand back to you now, Robert.
Yes, perfect. Great, thank you, Lois. Yeah, with the next section, we'll be talking about some elements which should ease and offer you some flexibility in preparing the disclosures. So we at IFRS, we have sought to apply a number of mechanisms to support preparers to get started with the ISSB standards. So one simple thing to put in place was to adopt well-known terminology and concepts familiar to preparers, borrowing from the ISSB, for example. Many requirements in S1 and S2 are to be applied proportionally, recognizing companies will have a range of capabilities and preparedness on the issues. For example, qualitative scenario analysis are permitted, and you will see the phrase all reasonable and supportable information at the reporting date without undue cost or effort, or commensurate with skills, capabilities, and resources in a number of places. So, and there are, on the top of that, there are some reliefs, especially for the first year of application, and these been introduced and include, for example, companies being able to limit disclosures to climate in year 1 and begin reporting on their sustainability-related risks and opportunities in year 2. Companies also might be able to provide annual sustainability-related financial disclosures with their next half-year reporting, rather than at the same time as the financial statements. And finally, companies not needing to provide disclosures about scope 3 greenhouse gas emissions apply the greenhouse gas protocol corporate standards to measure emissions if they are already using a different measurement approach, or provide comparative information in the first year of reporting using S1 or S2. Another relief allows companies to include greenhouse gas emissions information obtained from companies in the value chain with a different reporting cycle. We've already mentioned a number of other resources of guidance, including SASB standards, CDSB framework, application guidance, among many others. So these reliefs are designed to enable companies to put in place reporting practices and structures to provide high quality, decision useful information. And jurisdictions will decide at the end when to mandate the adoption, but the standards are effective from 1st of January 2024, and we know many companies are now preparing to adopt them voluntarily already. We'll have two polls coming in right now. Zoom poll number 12. information disclosed in accordance with the ISSB standards should be, and select all the matters which apply. Decision useful, B material, C misleading, D comparable. Perfect. So I see that great participation and answers coming in. We are approaching 50%. So I'll end the poll. And yes, indeed, this was pretty straightforward, and you are absolutely right. Yeah, information disclosed in accordance with the ISSB standards should be decision useful, material, and comparable, and certainly not misleading. So A, B, and D are the correct answers, and C is incorrect answer. Thank you. And with the next Zoom poll. So information, the question is, information is decision useful if it is A, relevant and faithfully represent what it purports to represent, B, comparable, C, verifiable, D, timely, E, understandable. So please select all the elements which are correct in this case. Yes, perfect. Indeed, you did correctly. All the elements are the qualities and of the useful information. So A, B, C, D, and E are correct answers. So thank you very much for this. And now we're moving to the last unit of this section about confidence and how to maximize confidence in disclosed information. So the last section of our last unit looks at how you can ensure that users of financial reports have confidence of data you're disclosing, as trust is an essential component of sustainability-related disclosures, and increasingly so with growing concern over greenwashing. So we'll be talking shortly about the comparative information. An important trust builder is show the data over the and trends over time. This is why ISSB standards ask for comparatives. And comparative information provides context, helps to indicate progress, and underpins strategy and risk management. Metrics disclosed by a company might be redefined or replaced over time, or the company might change its method of estimating a metric. In this situation, it is important for the company to revise the comparatives and to enable investors to compare and analyze current period figures with the relevant period prior period figures. So occasionally company sustainability disclosures might contain errors. And in this situation, the company is required to restate these errors in the comparatives provided. And revisions and restatements are necessarily only when there is a risk of that material information being omitted, misstated, or obscured as a result of not revising or restating the comparatives. The one last note on this one, companies sometimes express the concern when sharing information that they deem to be sensitive, that if shared, it could deplete their competitive advantage, and ISSB standards relieve a company from disclosing information about the sustainability related opportunity if that information is commercially sensitive. And now moving to very last section here. So finally, it's important to build confidence by providing clear statements of compliance. A company that complies with all the requirements in the ISSB standards, even the reliefs, is required to make an explicit statement of compliance. And on the very last slide in this unit, there's a list of the things to remember. So please go through that list. You can find it in handout slide deck, an additional slide in the section with reminders on how to report effectively. And I do highly recommend reviewing that. That's it from me. Over to you, Fiona.
Wonderful. Thank you, Robert, for taking us through that final module. And as Julie said, that was very informative. So that's excellent. Excellent. So that brings us to the end of our last module. So just to recap on this, I think some of the key messages we want to land on here is really, we discussed where to report the information, and what was important here was the audience. So thinking about who you're reporting to. And as we've established for the ISSB standards, the primary user of this information is intended to be an investor audience. And so being really clear on that and helping to ensure your focus on the information that is right for their needs is critical. Then we discussed efficiency. And I think the key takeaway there is that less is more. The objective isn't to overload your investors with information. Indeed, that could actually be a little bit harmful, as it could obscure the information that is required. So using the standards as you get started can be a good guide to make sure you're providing what information your investors need. And of course, referring to the Bursa Malaysia's requirements as well to make sure you're serving that audience too. And we finally then landed on the end point regarding confidence. So we spoke around the need to ensure that in that climate of risks around greenwashing and accusations of potential misleading statements, that you need to be as confident as you can be that your data is accurate, but is presented in a fair and transparent way that builds trust with your report users and confidence in what you've done. And we do hope that the homework assignment that we've given you to optionally take away will help you to get started with that. So to close us out, we're just going to be heading back to Menti for a final time, as Lois has shared in the chat. So I will briefly share that with you now. We may do this a little quickly just to make sure we have time for any closing comments, but we'll take a quick look together just now. See what ideas you might have around different navigation techniques. So I'll just move that along to that question. So yeah, any thoughts that you have on particular areas that can help to make reports easy to navigate and to use? Hyperlinks, of course, tables of content, content index, exactly. Infographics, data, summary tables, charts, automation, indices. Yeah, exactly. Loads of ideas here, using modular graphics, infographics, references. Exactly. So doing your best to think about that report user, make things as navigable as you can, and to really give them that view. So that would be fantastic. Excellent. So I think you've got lots of great ideas there that are along the lines of what we would recommend. We just recommend as well probably to look at digital tagging, so making sure you're looking at the machine readability of your reporting and using those taxonomies over time as well, and to think about digital reporting in the sense of not just having a PDF, but also having a perhaps a digital interactive report on your website. Sorry, I'll just return to Menti as I forget I have one more question to show you there, which I'll move along to now. So we just want to retest with you how comfortable you feel you are now as we're coming to the end of the session, which each of these different task areas. So we ask these same questions to you at the start, and it's always just great to get a sense of where we feel we are at the end of the session. So take a second and let us know where you think you're at with those areas. Okay. So I think we've shifted along a little bit from where we started at the beginning of the session and shifted just past the midpoint of comfort overall, which is great to see, particularly when it comes to using the standards and explaining them, which is great. And maybe a little bit of a distribution, it's fair to say, across the piece in terms of some people still feeling like there's a bit to learn, which of course is understandable. And we hope really that today just acts as a signpost to help you move that forward and to learn more in the future and know where to go for more support. Okay, so I'll leave that there, and then I'll leave you in the background to just complete this final screen or so, just to let us know what you think the best parts of the training are. That's always really useful from our side to get that insight. Okay, so just flipping back into the presentation for a few closing points. So I'll move us along there just to recap on a couple of practical areas. So as we've mentioned, there is a homework assignment. This is entirely optional for you to complete. It doesn't have to be submitted to us in any form, and you can find that on the event webpage, which we shared with you in the chat previously. So this follows the same structure as the Menti exercises and supports you in moving through those steps of prepare, align, implement, and communicate. So we hope that if you use that structure, you'll come away with the first draft of your disclosure plan to align to the ISSB. We'd also encourage you to take a look at some of the resources that our organisations provide to support you in this area. So don't forget to make use of the IFRS Knowledge Hub and the standards themselves, of course. Then we have the IFC's Beyond the Balance Sheet resources and their Disclosure and Transparency Toolkit, which act as a really comprehensive suite of resources to work not just on sustainability, but across broader topics of governance and corporate governance as well. And finally, on the resources front, we've mentioned these before, but just a reminder on the close working relationship the SSE have with the IFRS Foundation and our partners to support you on this topic. So please make sure to look at these resources as well. And I know we've had a few questions on this as we go along. So please make sure, as I say, to fill out the feedback survey so that you can receive your completion certificate. So we'll be sharing that link with you in the chat now. But if you miss it, you will also receive an email from Zoom within the next 24 hours, which will include the link to complete this survey. So if you keep an eye out for that, and when you complete the survey, it will give you your certificate within the next 5 working days. So please give us a little bit of time for that, but thank you for your participation. We do really appreciate that and want to show you that. And as we close out, we'd just like to say a final thank you to all of our official supporters for their support for this programme, which is very much appreciated. And of course to our partners in delivering this training, the IFC and IFRS Foundation, for sharing all of their expertise. Before we fully close out the session, I know we've had lots of questions for the Bursa and they've been doing a fantastic job at giving you their position. I would just like to hand back briefly to Hezri, who might just say a final close from his perspective as well before we close out the session.
Well, thank you so much, Fiona, and all the other panelists from the UNSSE and IFRS. 2.5 hours is a major feat for all of you, I'm sure, but we have learned a lot from this session and very appreciative of your efforts. Of course, there's a lot of questions being raised, very useful feedback to us as well. But I would just like to say that stay tuned for further announcements from from Bursa Malaysia on, further conversation on this topic. But I think just to record our appreciation once again to all of you who have been very patient in joining us for 3.5 hours and remaining enthusiastic throughout. And again, one more time, Fiona and team, we are very, very, very much grateful to this opportunity and hope we can have something along this time in the future, perhaps with different guys. Thank you so much, everyone.
Thank you, Hezri. I really appreciate that closing. And as we've shared in the chat from our side, our teams at SSE and IFRS are working on some FAQs as well that come from what we learn at these training sessions. So that resource will be hopefully available in the near future as well to support you with your other questions. So yeah, all that remains for me to do is just say a big final thank you to you all for joining us today. We've so appreciated your level of engagement and enthusiasm for the topics and all of your fantastic questions, which have really kept us brains active thinking about what the answers are. So that's always great for our team to get that. So brilliant. Thank you all again for the time. We wish you all the best with your reporting and hope to see you again soon. Thanks very much.